Good morning, everyone. It's 9 a.m. here in New York City. This is Yahoo Finance Live. I'm Brad Smith alongside Julie Hyman. And here are the three things that you need to know to start off your morning. Deflation is now a reality in China. The nation's consumer prices posted their first yearly decline in over 2 years in July, dropping 0.3%. Factory gate prices also fell, and the two happening in concert certainly catches investor attention this morning. Over in the U.S., all eyes are on tomorrow's CPI release, which should show price increases moderating. The core figure projected to rise 0.2% in July for a second month. Now, that would mark the smallest back-to-back gain in well over 2 years. ESPN making a big bet with Penn. The company is announcing a blockbuster deal that will see the Disney-owned sports conglomerate operate branded sportsbook ESPN Bet. Penn will pay ESPN $1.5 billion over the next 10 years for those licensing rights. The business falls in the 16 states where Penn currently operates mobile sportsbooks. A key part of the deal, Penn sold digital media company Barstool Sports back to founder Dave Portnoy. And WeWork still isn't working. The embattled co-working business saying that there's doubt about its ability to keep operating as a going concern. Now, it's a staggering fall from grace for a business that was valued as high as $47 billion back in 2019. The company has been burdened with debt after the COVID pandemic as customers shunned its office spaces and work from home took hold. WeWork stock has been trading below $1 since mid-March.
Well, China saw both consumer and producer prices fall in July. It's the latest red flag as the world's second largest economy struggles against slumping domestic demand. Could cheaper China prices help the U.S. and other world economies in their fight against inflation? Or is China's deflation in for a reversal in the months ahead? With more, we're joined now by Ben Emmons, who is head of fixed income and macro and senior portfolio manager at New Edge Wealth. This is something I have been struggling to understand, Ben, in full transparency. You know, how much should we weight the deflation that is happening in China?
If you go pre-crisis or even pre-financial crisis, it mattered a lot because China was producing all these really cheap goods that we imported, and that put pressure on our wholesale prices and consumer prices. But that's somewhat reversed now, even pre-pandemic, but mostly after the pandemic. So we've shifted away the supply chain to an extent. We're importing, but not as much anymore than we used to. And so this deflation that you're seeing today, really driven by pork prices and transportation costs, that's most of it, is just very domestically generated. And I drilled in the pork price dynamic of China this morning, and I noted that actually the government is taking some action there to try to tighten up pork supplies. So I think this deflation that you're seeing in CPI is probably mild, may stay, somewhat there, but reverse. And I think therefore the impact that it will have on other economies is limited.
Yeah, we're showing your pork price chart right there. I just had to highlight it because I love that one. I think it's very interesting what you're talking about with them trying to bring those prices down.
Yeah, and we saw it in your note this morning, too, even as you were laying it out there a moment ago. You also noted as well that there's a second batch of Central Pork reserve collections to stabilize prices that's coming about. But you also mentioned in the note that the entire world doesn't revolve around Chinese pork purchases. So where else should we be keeping a close eye on, especially within the second largest economy right now, to really monitor where those signs of weakness are persisting, or where, on the other side, for companies that are looking for any kind of sign of strength within that economy, where would you be keeping an eye on?
Yeah, you look first at foreign direct investments, because that's, I think, key. So China has been really opening that gateway up again. But we know how they operate, right? They don't let everything come in at the same time, and they restrain capital to an extent for being, exported out again once you have invested there. But I think that's a key part, because you get the opportunity to invest in China. It is the biggest consumer market. So as much as the pandemic as an after fact, which is a study out that there's long COVID in China that's actually depressing to an extent consumer demand. At the end of the day, I think a lot of U.S. and other companies will be willing to expand their operations there if they are allowed to. Now, we do know from the administration the other day, they put it specifically on semiconductors, a new policy out that they want to restrain that. But I think if you otherwise think of Tesla or Apple or any of the GEs, other companies, China opening up its borders, that's the big deal. I think that's what we want to watch.
Yeah, and there's some reporting this morning, some new reporting that there could be a curb from the U.S. on certain types of venture capital and private equity investments in China as well. So I am curious, yes, there's a lot of U.S. companies who do a lot of business in China, but by and large, the U.S. equity market writ large seems less concerned about the China slowdown overall. Is that the correct reaction? Is that, are U.S. investors sort of paying less attention to China at their peril?
So we came into the year, there was a lot of hope about this is the China reopening, so it's going to have a big macro story. In my view, it's still there. Like it's actually just slower reopening, a slower effect. And that's maybe where the decoupling has taken place over the last number of months as the AI narrative really hyped up in markets. And people don't look at China so much in that AI context just yet, even though they're a huge competitor, as we know, which is more focused here on domestic companies repositioning itself for the AI hype and is spending there. And our domestic economy is just being thriving on that we had a moderation of, to some extent, inflation that's boosted real incomes. So I think that is really where that decoupling between US markets and China markets is for now. So that leads you to the point of that, let's say this reopening actually becomes a bit more surprising in the second half or the first quarter of next year. I think that we can conclude that China reopening last year in the fall is starting, that probably has affected Europe and the US economy staying out of this presumptive recession. Because let's face it, the trade between US and China is huge, as well as Europe. I think that has kept the situation sort of together. But the financial markets have judged like, well, this is a slow motion process, so let's focus on other things. I think that's why you see the decoupling.
So in other words, sorry, just to follow on that, so you think that when we do get more to the conclusion of that reopening process, it could provide some further upside?
I think it is, and I think that, as I said, like the reopening one hand of foreign direct investment into China, that would affect the stock market here, obviously, because we know this is a huge area where you can generate significant sales. Simple statistic I know from Apple is that I think they generate over 300 billion in sales in China. So if that can boost that, which the sales numbers have been sagging, now there would be an impact on our markets, right, given Apple's weight in the market. On the other hand, it's also about China's own reopening in terms of outward, like as in they have looked at investments outward. There was a policy statement out the other day of trying to put more money into outward investments, which I think means investing in other real estate or property or companies. On the other hand, there's also this tourism wave. That's sort of my own personal view. It's interesting how Vietnam has had a record inflow of Chinese tourism just coming through now. That's the latest statistic. We haven't seen China tourism pick up so much just yet. I think that's another sort of, let's say, reopening tail that we're going to deal with coming from China.
And so we've been in such a kind of de-globalized environment for the past few years now, as we think about the ties and some of those severed ties between U.S. and China on the trade front, that has caused officials to have to come back to the table and try to get new deals done. But in the interim period, now you've got the reopening. Can a reopening in China drive re-globalization in the next year, 2 years? And what does that look like for people who are waking up this morning hearing us talk about this in the A block of this show and trying to figure out what that means for their portfolio?
Yeah, and the re-globalization would be fantastic, but I think it's a bit of a difficult reality because just listen to the rhetoric coming out of the campaigns now. Former President Trump wants to raise even more tariffs on China if he gets into office, as one example. And the current administration has maintained his policy. That's been actually very much of a pillar of the quote-unquote decoupling or decoupling of between US and China in terms of trade. And that is actually, I think, a key, let's say, geopolitical or political policy towards, in order to see this re-globalization really take place. On the other hand, look, trade is trade, so companies want to trade with China. And as long as there's not as much as restriction on that, then it will flow as China tries to further reopen its economy. So I think you'll see some effect coming through in a number of quarters from an improvement of trade between China, US, and Europe, just from a flow perspective. But long term, if these tariffs stay in place or it becomes even more political as we're hearing, then I'm not sure if the re-globalization is so easy to achieve.
All right, Ben, stay with us. We've got a little bit more to discuss with you here this morning. We got to talk about regional bank stocks. They are looking to claw back some ground after Moody's cut its rating for 10 small and mid-sized U.S. banks on Tuesday and put 11 more on a negative outlook. Now, this comes as the KRE Regional Banking ETF has yet to recover from the failures that started during March. So are we headed back into a bank doom loop? Let's bring back in Ben Evans, who is the New Edge Wealth Senior Portfolio Manager, head of fixed income and macro as well. So Ben, perhaps we start on that question and define for us what a doom loop would look like.
So it's a phrase coming from Europe, where the ECB has put this out actually amazingly. They said like, okay, the banks get into this loop between the sovereign and banks, meaning the banks hold a lot of sovereign debt. The value of that sovereign debt declines. That affects the stock price of the bank. The bank has to sell those sovereign bonds to make up for their capital requirement because of the lower equity value. As a result, sovereign bond prices fall even more, and that declines the bank stock price and so on. So that's your sort of loop idea. Now, if you take us to the United States, the regional banks are sitting close to $4 trillion of US treasuries in their portfolios. This is including the major banks, but a vast amount of it sits in regional banks. We know that the value of the treasury bonds has been declining, of late particularly. Moody's made a real specific note of it in their statement about that these unrealized losses in their portfolios continue to increase, which puts pressure on the bank's balance sheets and have to therefore raise reserves in order to offset those losses against other losses that they probably are facing on their commercial real estate portfolios. So there's a bit of this loop idea there too. If treasury yields go up and the value of treasuries declines, it pressures the stock price of regional banks, who then have to sell those treasury bonds to make up for those losses and also build up reserves, and that can further affect their stock price. You look at the Fed data every week, which is this H8 or H4 data. It sounds like R2D2. H8 data, it shows every week the Treasury security holdings decline. That's not just the Federal Reserve, that's also commercial banks. And that note, I took note of that, thought like the banks are really looking to try to change their composition of the balance sheet, but it is that loop idea. This is why the KRE ETF, to finish with that, has not really recovered from the March lows, right? It's still down about 15% year to date. It's trying to break out a bit, but it's really struggling. I think that's caused by this loop idea.
But sort of quantify all this for us. Like how doom loop makes it sound pretty bad.
Yeah.
But, yes, we had Silicon Valley Bank, which had some particularities on its balance sheet and, that caused it to go under. But presumably these other banks are still in better shape, even if they're having to undergo this process. And I also have to wonder on the flip side, how high yields are going to get. Like how much further could we see, could this cycle sort of go on? Yeah,
I think, Julie, that's a good point, because the rise in rates that we've had over the last period, you could attribute it to that, the economy's been resilient, a surprise, and all that sort of positive dynamic, and markets reacting to what AI could do to productivity, and the other day productivity data was really strong and it drove up rates even more. So that's the macro side of it. But the micro side is that specific idea of that the banks are having a credit issue. There is an underlying deterioration of credit, and as a result they have to, quote unquote, delever their balance sheet, meaning probably take out of their portfolios of treasuries more out of that, sell more bonds out of that in order to make up losses.
I get what you're saying, but then what's the conclusion? Is it just that their stock prices remain depressed for a while? Do more banks go under? What ends up happening as a result of all this?
I think the first one first, that you have stock prices that are not really recovering. Just like what happened with the big investment banks post-financial crisis, in some sort of an L shape. Citigroup is actually a really good example of that. Never really recovered. I think for some of these regional banks, that's the same. Second is that there's likely going to be more of these shotgun mergers potentially happening. PacWest is that example. You could see more of that. And thirdly, which by the way is dilutive for equity holders potentially, right, if you get these type of mergers. And thirdly, it's about that the credit crunch will continue. It will continue to slowly burn under the economy because banks have to pull back as a result of their imbalance on their balance sheet, so to speak, right? Interest rate risk is too high, they have to bring it down. And I think that slow burn credit crunch under the economy, eventually it comes to surface and does really slow down the economy. Don't think it will happen this year, but it is a possibility for next year.
So if you've got other traders that are out there anticipating what that doom loop could look like, I mean, I'm taking a look at short ratios right now, and the short to float ratio, and that's 21% for a company like PacWest Bancorp. I mean, you could go down the list and probably look at how that's moved even since March, but does that set up for some type of massive short to come in for these small or mid-sized banks? And then on the other side of that, does that then make the mid-sized banks or the small and regionals even more memey, as some of them had become, at a point coming out of March?
Yeah, that connection between meme call activity, the bet on sudden pop in those stocks versus the probably institutional speculative investors taking short positions. I think that's a relationship that's in place now. Will probably continue. I will point out too, to the options market, you can calculate probabilities of stocks falling really, well below a $5 threshold price, which tends to be where banks get in serious trouble and have to go to the FDIC. That probability is still up to about 15%. So there's pressure there, and I think that meme idea, yeah, you get certain days, like a day maybe like today, you see sudden like major pops in these stocks, which is a bit deceiving in a sense, right? It doesn't really tell you about the health of the bank. It tells you more about real technical underlying factors that, on the one hand, people take a fundamental view on these banks saying, I'm going to short them or allocate away from them, against those who want to speculate in the options market.
Finally, I just want to take it back to the Treasury market for a second, because even with this loop happening, potentially putting a little more pressure on Treasury prices, isn't there a floor under Treasury prices? And where is that floor? Because there is sort of this intrinsic demand that's just going to be there for Treasuries, right? So I guess, where's the floor for prices, and conversely, the ceiling for yields in this particular cycle?
So if we believe the Fed's projections, and they are getting inflation really under control, and it slides down to the 2% target, the long-term interest rate for the Fed that they've estimated is 2.5%. That will be your floor, if you will, meaning 2.5% yield, higher price. I think that's where we're potentially going to head in the future, which means where we are currently at 4% in the 10-year or about, probably is going to be in some area there, a quote-unquote ceiling. Now, I'm a little cautious because the dynamics around the Treasury market are significant. Take the 10-year auction tomorrow. It's now more anticipated than ever before. We don't know how much bidding there will be from whomever comes in that auction. I think it underscores where we are currently. Right? We have a resilient economy, but we got a banking system that's sort of crunching and bleeding, and we got these different pressures on the Treasury market. Besides that, we have to digest all this additional supply from the Treasury that was announced last week, that may, by the way, continue in the following quarters. And as another factor, that the floor is you can quantify the floor from the Fed's forecast, but the ceiling on rates is, I think, a little gray area. So I take the view of that we'll probably test the upper end of the range, which is 4.3 initially, and then see where the demand really comes in there. And that's to be seen tomorrow.
Interesting. All right, we'll be watching that Treasury auction then. Ben Emmons, good to see you. Thanks for coming in. Head of Fixed Income and Macro and Senior Portfolio Manager at New Edge Wealth. Thank you. Well, the hotly anticipated largest IPO of the year is reportedly getting a huge new investor. That is Amazon, which may become an anchor investor in the public offering of ARM, the British chip designer owned by Japan's SoftBank. All of this according to Reuters. Amazon would join the likes of other reported investors, including Samsung, Intel, Apple, and NVIDIA. The latter, whose $40 billion purchase of ARM was derailed last year by regulatory concerns. ARM primarily designs chips for smartphones, but investors may be betting on future growth areas like data centers and, of course, artificial intelligence. The IPO reportedly set for September. It could give the company a massive $60 to $70 billion valuation. Let's get more on the IPO and its bigger significance, both for the IPO market and for big tech. Hallie Garfinkel's here with us in the studio, and Dan Howley is joining us remotely as well. Guys, thanks for being here. So I've been trying to sort of like wrap my head around these various investors in ARM and sort of its bigger meaning. Hallie, I'll start with you here. How should we be contextualizing this?
So I think that we should start with Amazon, and we should remember And unlike a lot of tech companies that we think of as going to IPO, this is a giant profitable business. And it has a list of clients that would make most startups absolutely salivate, right? Think about, for instance, Amazon as an investor in ARM. They've been trying to build up their semiconductor business. You have Intel, which has a deal for foundry work with them. NVIDIA uses them in their Grace CPU. You know, there's a whole world of companies that are already working with ARM. So I think the thing I would say, Julie, as a place to start is this is part of the cosmic dance around chips and AI that we're seeing in tech at large.
And so, Dan, when we think about the intellectual property that a company like ARM has been able to tout, even as some of the filings about their relationship with SoftBank, which is very storied at this point in time, how that really classified the company as a leading semiconductor intellectual property supplier, and then scalable components as well. Where do you think that the investor reception for a company like ARM would look like once they make their debut?
Yeah, I mean, that's going to be the interesting story here as to, where the investor sees this company going. Let me just give you kind of a level set of where you'll find ARM's stuff. They're in virtually every smartphone you can think of, whether that's coming from Qualcomm's devices or chips. Those are ARM-based. Apple, those are ARM-based. Samsung uses Qualcomm. Google uses Qualcomm, smaller player, obviously, in the smartphone space. So that means that it's in tablets, it's in smartphones, it's in laptops and desktops. Those are ARM chips that Apple uses in its laptops and desktops. On the Windows side of things, Intel's still the big player, but Windows is trying to get low-power PCs to be a bigger product, and so they've worked with ARM as well to get some of those chips into PCs. They're also available on the server side of things. They're, as Ali said, they work with NVIDIA as far as the Grace CPU, not the GPU side. That's very important to point out. It's just the CPU side, although ARM is trying to work on its own GPU. So this is a company where they're already spread across the spectrum of devices, vehicles, smart home stuff, smaller connected devices. It's everywhere. So this isn't a company where if you're an investor, you would say, oh, gee, this has got a huge chance for growth. Sure. As far as the AI boom goes, yes, but they're a company that already, as Ali said, does great business. They're profitable, and they've been around for quite a while. So I think for the average investor, this, looking at an IPO, it's not something where you would jump on and say, boy, is this going to be, the next NVIDIA? Is it going to blow up like that? Perhaps if they dive deeper into AI, something that they're trying to position themselves as an AI play, that's not really where the company is, though. But that's the way they want to position themselves. Maybe then that's where investors would look. But I don't think people should look at this and say, this is a brand new company by any stretch of the imagination.
And I think kind of it's also important to really highlight this point Dan is making. ARM's business currently is semiconductor IP. It is not AI. This is not an AI play in the traditional sense where we're thinking of NVIDIA as an AI play. As they've sort of been trying to move towards going public, they have been saying things like, on small devices, small scale AI processors, we can run stuff like that. But that is the future business. It's not an AI play today. And kind of to that end, I'm looking at the banner and I've talked to a lot of experts about this. ARM is completely singular. This isn't a VC-backed tech company in the traditional sense. If you're looking for IPOs down the line, the real ones that are going to start a new tech IPO boom are going to be the Instacarts of the world, the SpaceXs, the Stripes. Those are the ones that everyone's saying is really where all of this is going. However, I think it is really important to say, ARM is still going to move the needle forward. We're not going to see an IPO boom like we did in 2021, but it is going to be, using the weather metaphor, it's not going to be a flood, but there's going to be a light rain.
Well, I guess what we could also look at with all of those companies is the deal size and the raise that would be taken on. I mean, SpaceX, the even private valuation that we've seen of all of those companies that were just listed on the screen, some of the largest that we have seen in history, and ARM included within that conversation too. So it's right to bring up, whether or not this is going to bring a windfall of deals, but in terms of where we sit right now in the IPO market and 2023 far kind of paling in comparison to 2 years prior, as we know many companies rushed into, they look for a good environment where there is less choppiness, less volatility, and that's not necessarily this environment right now.
No, it's not. And I've talked to some folks who believe that 2024, early 2024, is when we're going to see some volume really return here, Brad. But you're right, it's a different environment. Money is more expensive. The environment is uncertain. It's not exactly the moment that if you're sitting there in your Stripe, you're thinking, this is exactly the moment I was thinking I wanted to go public. It's the sort of thing where I think there would be a lot of excitement around, say, a Stripe or an Instacart, because if for nothing else, it's disclosure, right? We would see the business for the first time. And in the case of Instacart, we would see how much of a business they really built during the pandemic. But for now, you're right, we're sort of just, we're sort of in waiting, I would say.
And in the case of ARM, we already know about the business.
Yeah,
right?
we know so much.
In part because it's it used to be publicly traded, but also as part of SoftBank, which is a public company, we get disclosures about its earnings. So that's
and NVIDIA almost bought them for $40 billion.
Yep, and then got shut down. All right, thanks guys. Ali and Dan, appreciate it. We'll be watching this to see if indeed it does go public in September. All right, we got much more coming. Stay tuned. You're watching Yahoo Finance.
It's been a wild year in the retail space. Inflation has dominated the headlines, causing shoppers to spend more cautiously.
As a result, profits at major retailers such as Walmart, Target, and others have come under pressure.
Organized crime and a growing list of bankruptcies also continue to cast a shadow over the entire industry.
But what does this all mean for the future of the sector? Should investors dive in or steer clear of retail stocks?
We'll bring you key analysis and hear from some of the biggest names in the industry to answer key questions.
Who is the consumer visiting? What can retailers do to stop the rise in theft? Are more bankruptcies on the horizon? And where does AI fit into it all? It's all part of our week-long special, Retail Evolution, The New Era, starting Monday, August 14th, right here on Yahoo Finance. You won't want to miss it.
Well, that was the opening bell on Wall Street. Carlisle ringing it today. Let's do a quick check of the markets as we get underway, sponsored by Tasty Trade. We've had some rockiness as of late for the major averages, in particular yesterday, seeing a slump, particularly in those regional banks on the back of the Moody's downgrades. But, you know, every day's a new day in the markets. And today we're seeing a little bit more green on the screen, although it is very small as we get underway here this morning, with the Dow just up about 10 points and the S&P only rising about 2.5, less than 1/10% for each of those. Still waiting for the Nasdaq to open up, and it's moving just about the same amount here this morning. So a little bit of water treading. Brad, I'm betting that a lot of investors, yes, while they're looking at earnings, are also looking ahead to the CPI data that we're getting tomorrow morning, and maybe sort of holding their bets until they get that important number.
Yeah, but here for today, every day is a new day, as you mentioned, and they're going to be tracking exactly where every day becomes a winding road in the markets. For the Dow Jones Industrial Average, as of right now, you're seeing that flat just barely to the downside. That is ahead of that economic data that Julie was mentioning a moment ago in the form of CPI that investors are going to be paying close attention to, and perhaps we'll see a little bit more of a concerted activity after that comes out. However, for here and now, as Luther Vandross would say, you're taking a look at the Nasdaq Composite, flat just barely to the upside. The S&P 500 about as flat as it gets there. We'll see if that can make up its mind, but it's hyper oscillating, waffling between gains and losses as of right now here. We'll see if that can make up its mind on this Waffle Wednesday. Let's take a look at the 11 S&P 500 sectors, as we always do to kick off your trading session. Taking a look at XLE, that's leading the pack. That's up 0.9%. And pulling up the caboose here, you've got financials and real estate, and then additionally utilities decided to get it in on the negative party, as well as XLV. You're watching healthcare, that's down, just flat, just barely to the downside here. But where is tech here on the day? Tech is still higher here. Let's take a look at some of the Nasdaq 100 names. And yesterday you saw a lot of red on the board here. Right now, roughly mixed, it seems a little bit more in the green than in the red. That is good. But pulling up the caboose here, Lucid, that's a company that we're going to talk about just a little bit later on. But anyway, WBD, that is leading the pack right now. It's up by about 2% here. And lastly, we got to check in on how one of the biggest names, the trending tickers in the Yahoo Finance platform online this morning, are doing. And one of those, of course, none other than Penn Entertainment, coming off a major deal with ESPN. And of course, they gave us a little bit more insight into their financials as well this morning, taking a look at Penn shares over the past 3 days and much of that move. Let me just put this on intraday so you can see that move to the upside there. And you're seeing that up by about 12% to start off today's session.
Yeah, exactly. We were excited to see that that news cross last night, that ESPN's finally coming out with a sports betting product, I guess, in partnership with Penn Entertainment. But as part of that, Penn Entertainment divesting itself of Barstool Sports, selling its stake back to founder Dave Portnoy.
Dave Portnoy,
I was blanking on Dave
Davey
Portnoy's
Daytrader,
first name,
as he calls himself.
And, you know, so really interesting. We have been seeing some of the other online gambling companies falling in early trading as well as Flutter, the parent of FanDuel, which reported its earnings today. Penn reported earnings that came out a little bit better than estimated, but as you said, really overshadowed by this agreement. DraftKings down 7% over the past 2 days. We're going to be talking to an analyst later about this whole landscape. I think it's really interesting.
Oh, it's fascinating right now, especially at a time where we're going to be ramping up into what? NFL season, football season. Even though I missed out on my Kelly Green Eagles jersey, guess what? There's a lot of bets that are still going to be made on them Eagles this year.
I wonder what the size is of globally real football betting versus American football betting.
Probably outsized here.
We gotta look at up those. Outsized here, but I mean globally. I'm curious.
I mean,
I don't know.
Yeah. We'll see.
We'll look it up. We'll look it up.
Yeah.
It just occurred to me. All right, let's take a look at some other trending tickers today. WeWork is certainly on the list. The share's plummeting 28.5% after the company issued concerns regarding its survival. WeWork says co-working clients are canceling their memberships at a faster rate than the company originally expected. Now, we know for a while here that WeWork has had a little bit of trouble in terms of its cash position, but now issuing this, going concern warning, if you will, raising more concerns about its ability to survive at all. I mean, the story of WeWork is obviously stunning. There have been a lot of documentaries made on its rise and fall. The company, remember, by the time it actually ended up coming public through a SPAC in 2021, Adam Neumann had already exited the company 2 years prior. And then the pandemic, really had caused a big issue for its business. The company's losses last quarter, $349 million. That was actually a smaller loss than a year earlier, but when you're running out of cash, you're running out of cash.
Yeah, indeed. And I mean, when we think about the physical occupancy, consolidated physical occupancy right now at 72% at the end of the second quarter of 2023. Now, they did see that was an increase from 70% at the end of the second quarter of 2022, but think more broadly about how the workforce and the workplace environment has changed so dramatically here, with the amount of people that are still perhaps leisure travelers and are just kind of floating around, or digital nomads and are continued to allowed to be so. That's less people that need to go to a WeWork, with the companies that are saying, you know what, we're going to go in the opposite direction. We're going to bring people back to the corporate environments, or we're going to move around our physical locations and make sure that our leases that we have are more advantageous for the amount of headcount that we may have right-sized in some places, or we're just looking at a different facility that we'd like to go into. That also impacts the WeWork, because that's less people that need to go into one of just the virtual settings that they can dock, work for the day, and then keep it moving. And I think a lot more of the creator community as well that would have relied on a WeWork and making those connections pre-pandemic, many of them are realizing, all right, there are much more digital ways that they can continue to engage and drum up more of a client base here.
Right. But of course, even before the pandemic, there were a lot of questions about WeWork's business model, whether it was worth the valuation that initially was ascribed to it, because effectively it's a subleaser. That's what it was, right? That's what it is. And so, does the WeWork magic really mean that it should be worth whatever? Well, now it might not be worth much at all. So Another stock we're watching this morning is Lyft. Shares are trading lower after the rideshare company reported its slowest revenue growth in 2 years. Lyft did beat street expectations. Sales were up 3% to $1.02 billion in the second quarter. Lyft also raised its full year outlook. Lyft ridership, by the way, is not back to its pre-pandemic levels, which is interesting here. 21.5 million active riders on the platform in the second quarter. The share is taking a hit of nearly 10%.
Yeah, and even with that kind of 3-month marker that we've been looking at in the active rider growth that they were talking about year over year, it's a growth rate year over year of about 9.8%. And then what you should also do, everyone, when you're looking through kind of the 3 months ended June 30th, one thing that sticks out to me is they actually saw a decline in the average revenue per active rider as well. That was down by about 4.8%. And so earning less for each active rider right now, that's coming in at about $47.51. And just to correct myself, it's actually 8.2% growth rate that they had seen in the active rider base year over year. But still a larger question for this company about where they're continuing to be able to add on more of those drivers to engage with riders as well. And for the drivers, if you had asked them, because I always ask every Uber or Lyft driver that I take a ride with, I'm like, hey, how do you enjoy doing this? Which app do you find yourself toggling into more? Because they're just switching between all of those. And it's the ones that have more of those functionality and features that allow them to not just make sure that they're giving people rides, but also the packages that can just get thrown in the back of a car and taken somewhere. And so it's more of that optionality, and that's what I'm waiting to hear more from Lyft about, where they're going to continue to layer that into the experience.
Right. Something else I just want to highlight quickly here, because again, the numbers on the face of it beat estimates, but I'm seeing some analysts here cut their EBITDA estimates, particularly the folks over at Morgan Stanley, who say that there are rising insurance costs, and there are multiple analysts who are mentioning that issue of rising costs related to insurance as a headwind for Lyft.
Absolutely. We're also watching shares of Warby Parker today. That stock is on the move this morning as we're tracking shares of WRBY. Do they have an alibi? Seems so. They're up by about 7%. After the eyeglass retailer saw a surprising jump in profit this quarter, Warby Parker saw average revenue per customer increase more than 9% in the last year. They also raised their full year 2023 outlook. There you're taking a look at some of the actuals versus the estimates. It was a beat on top and bottom line, as we mentioned here. And if you've been keeping tabs of shares of Warby Parker over the course of this year, it's been an interesting one, but all in, they're still higher by about 6.4% year to date. That's underperforming, though, some of the U.S. major averages, especially the Nasdaq and the S&P 500.
A great irony of Warby Parker is when I go to their press release on their investor relations webpage, man, this font is hard to read.
Yeah?
It's faint, It's
Well, they're
small.
testing your vision. They're testing your vision.
I'm not passing.
They're trying
that
to make
test.
us set up that new optometrist.
I would like a much more like large.
Like the large font.
Something.
Top of the pyramid. That is pretty
it's
small.
not
yeah.
easy to read.
Yeah.
But they raised that forecast, as you mentioned. Now they're looking for revenue growth of 9.5% to 11% versus last year for this full year, and they're looking for adjusted EBITDA of $52 million. I mean, I think for any of these startup companies now, and this goes for something like a Lyft as well, by the way, even though it's more mature in its journey, but I think investors have been focusing for some time now more on profitability than they were, whether that's by an EBITDA measure or by an absolute net income measure. And so I think signs of incremental progress are seen as positive by investors right now.
Yeah, but that contact lens business, I mean, if that continues to be the product and the service that more consumers continue to buy into, and instead of saying, hey, I want to get some fresh new fancy glasses. You've got a lot of fancy frames. I try to keep pace. And
you got a lot more frames than I do.
Oh, I gotta rotate them in and out here because I know you're coming with clean frame game here, so I gotta try and keep pace. But at the end of the day, for Warby Parker and all of the different products that they've said that they need to move into and need to continue to drum up, for contact lenses, that's not the same type of margin and profitability that they've been able to see from some frames. Yeah, yeah, exactly. All right, well, that's an interesting way to enact demand generation, Warby Parker, by putting small font size on your investor relations pages. All your markets action straight ahead. Stay tuned. You're watching Yahoo Finance.
I mean, seriously. August and September don't tend to be good for stocks. What do you think is going to happen this time around?
Yeah, September, October can be real scary times in the stock market, but the top tends to come in the month of August. And so people need to be a little bit careful here, especially with interest rates moving up to where they are, banks being downgraded, and the market being as expensive as it is. Doesn't mean it's the end of the world, but it does seem to me that people need to be a little bit more cautious about chasing the market right now.
Tech buyers cashed in on the Nasdaq dip Tuesday, but further analysis shows more downside for Apple. Yeah, that may be on the horizon here. For more on this, we've got Yahoo Finance's Jared Blickery joining us now from the floor of the New York Stock Exchange. I guess Stacks Exchange works too. Jared, just go
when
ahead.
in Rome.
Yes.
Let's go to the Wi-Fi Interactive and move on here. I was looking at the Nasdaq 100, and we'll get to Apple in a second because Apple is the biggest component of the Nasdaq 100. But just wanted to show you what this tech mega cap heavy index has been doing. This is a 3-month chart. It's hard to see here, but this candle yesterday was a hammer candle, and it's protecting. It's showing that the 15,200 area was rejected, although 15,300 remains a sticking point. If you take a look at 1-year chart here, you can see this is kind of price for perfection here. It's one of those mornings. We did pick up interest right where we should have at the bottom end of this trend line here. But in as much as the biggest component is Apple, and Apple has not been doing well recently, you take a look at the 5-day price action, down 7.1%. This is a stock that has an even steeper trend line. Look at this trend. This goes back 1 year, but since January, almost a perfect uptrend here. And when it broke 4 or 5 sessions ago, and I'm gonna zoom in here, it really broke hard. In fact, this was a record high. It's hard to see up there, but a record high. Only 5 days later, this guy was oversold. Apple was oversold to the downside versus relative strength index. That's RSI. It's a common measure of overbought, oversold. I don't want to get too deep in the technicals here, but I went back through history and I found that this has never happened before. In other words, we've never had a record high in Apple and then it crashed to oversold territory within 5 sessions. So I expanded the parameters a little bit, just required it to close above a 10-day moving average and then get into oversold territory within 10 days. And guess what I found here? It's generally bearish for Apple in the following 5 days, 10 days, and 21 days. So that's 1 week, 2 week, and 1 month. In fact, here are the stats here. 9 times in history, and 6 of these came after the year 2000, going all the way back to the 1980 IPO of Apple, and we find that 1 week later, the average and median gains were negative. 2 weeks later, average is negative, although the median is positive. But some of these percentages are pretty bad. A 33% positivity rate for 1 week later is very low, considering this is a very bullish stock, and it has been a very bullish stock for the better part of the last 2 decades. So all of this tells me right now is that if Apple does not participate in this rally, it's going to be difficult for the Nasdaq 100 to hold its footing. And what does that mean for the rest of the stocks? Well, I was saying yesterday that it looks like we've been in a kind of a 10-day either consolidation or back off from highs or a rotation. Here's the 5-day price action. You can see while Apple down 7%, meanwhile, Amazon is up 8%. So there are winners and losers in this game. And actually over the last 5 days, Energy's breast broke to the upside. Then we have XLY, that's retail and Amazon, and then healthcare. We had a huge day in a couple of healthcare stocks yesterday, the Ozempic maker, as well as Eli Lilly. Just take a look at what's happening with energy. I'm going to put a 3-month chart on here with some candlesticks, and you can see today we broke above this resistance here, above 88 for the first time in quite a while. Let me just put a 2-year chart so we can see this. There's a lot of overhead supply still in the market here for XLE, but we get a little bit higher and it could be off to the races. Also taking a look at financials, despite yesterday's downgrade that we've been talking about of Moody's on the regional banks, financials have been relatively strong. Here's a 5-day chart, and you can see marching up from that initial sell-off yesterday. So I wouldn't cut out the financials here or count out the financials. Healthcare picking up, energy picking up, perhaps to the detriment of some of those big tech stocks like Apple that we've been talking about. But overall, as long as we see rotation in the rally, it probably means that the S&P 500, which is a broader mix, will at least hold water, if not advance.
Jared, thanks a lot. Appreciate it. A deep dive there. Appreciate that. Luminar shares are on the move this morning after the company posted a 63% jump in revenue year over year as it doubles down on partnership opportunities, including a new trucking deal with Plus. The company specializes in LiDAR technology that creates or uses lasers that help enable autonomous driving. Luminar CEO Austin Russell is joining us now. Austin, it's good to see you. It's interesting. Last I checked, the stock was not dropping, but now we're seeing it drop in normal trading. I mean, a lot of the what goes into investor interest in the company has to do with the future. It's not what you guys reported in this earnings report. It's the partnerships, it's the promise of future revenue and eventual profitability. What are you most excited about around some of the partnerships that you guys are announcing? Austin, we're not hearing you right now. I don't know if it's on your end or our end.
You got it. Yeah. So we had a great quarter. Exactly. It was, we absolutely meet or beat all of our various expectations, when it came down to it between, revenue, earnings, et cetera. But in terms of the full year guidance, I think the key is, we're continuing to execute. Obviously, when it comes to like market dynamics, the day-to-day stuff is kind of very, very noisy. But obviously, we're taking a long-term outlook of what we're able to do, and we're pulling it off very successfully. So when it comes down to the business, across, as you're pointing out, multiple partnerships between and advancements in major commercial wins, across like Mobileye has some new advancements this past quarter with a new OEM partnership that we're working with. Polestar is now offering our system available on their vehicles, which you can officially order. It's now the third vehicle model that you can have with Luminar. Nissan is showcasing additional capabilities with Luminar, including now intersection collision avoidance, and very exciting one. Their CEO has stated that they ultimately want to have our technology as we execute standardized across all their vehicles and the vehicle lineups by the end of the decade. And then, of course, Plus, which is, great new partners of ours, working with some of the largest logistic companies like the Amazons of this world that we're able to see our technology deployed into. So really firing on all cylinders, and all of our subsidiaries taking off as well. But yeah, it's the good time. Got to stay focused on execution. That's what we're doing.
Austin, across some of the AI ambitions that companies like yourself and even as we think more broadly, whether it's some of the larger tech companies like a Microsoft or even some of the other major automotive manufacturers like Tesla or Ford, GM, many of them have said that we need more semiconductors, we need more chips in order for artificial intelligence to really be to come to fruition within the mobility experience here. What type of investment is Luminar making in that, and how much, what type of kind of profile or, volume do we need in order for the amount of semiconductors to actually meet and get us to that reality?
Yeah. Well, the cool part is that we actually started investing in this very early on. We made a big bet on this between, some advanced semiconductor capabilities and AI capabilities about 6 years ago. So this is really starting in 2017, kind of went into full swing. So between those two things, you won't see a single, car equipped with Luminar deployed without being powered. They're all powered by AI and powered by Luminar semiconductors as well that are embedded within the LiDAR system. So this is something that, we're very excited to be able to get out there on the road. And this is where, we've also had, established new AI partnerships, including with Scale AI, that's now exclusively to Luminar, providing some key technologies as part of powering the Luminar AI engine that we're continuing to be able to advance. And at the same time, we actually already have active wins. In fact, people have found our technology so interesting from a semiconductor side, even outside of automotive, in terms of people using our same semiconductors and chips, including organizations like NASA that recently gave us an award for some breakthrough laser semiconductor technologies. So very exciting time, and we're making it happen all together on those fronts as well.
Austin, I know you guys have targeted at least $1 billion in your order book by year end. Talk to me about where you are with getting to that goal.
Yeah, so we're on track to meet or beat that, just as the other goals that we have at the table, including the industrialization goals and getting the high volume factory up and running live for start of production readiness for our automakers before the end of the year. So that's a key inflection point and game changer for us, as well as our other business goals more holistically, and economic goals, which we're all on track to meet or beat every single one of them. So, it's like I said, we're firing on all cylinders to be able to make this happen. And this is how you ultimately take the opportunity to see some massive market penetration and, can build a $100 billion company at the end of the day, or even $1 trillion company at the end of the day, as we were able to actually successfully scale, penetrate the technology throughout the market, and get deployed on more and more vehicles. We already have over 20 vehicles, under contract with us across the various automakers now. So, we're exponentially expanding. Like I said, we just Polestar just made available our third to be able to launch. So we're just running through that, and we really start to see that multi-billion order book that we have start converting into revenue, really starting next year and then coming into full swing in 2025.
Yeah, so just for for the investors, there's that window. I also am curious from the consumer perspective, from the driver perspective, and we've talked about this before. Like by the end of 23, 24, 25, give me a feel for like how many cars on the road are actually on the road, not just in development, are going to be deploying and employing your technology.
Yeah, so when it comes to the technology, this is actually the first time this level of technology is being deployed on real production consumer vehicles. You know, you oftentimes will see for the autonomous vehicle landscape, huge roof racks full of, sensors and a supercomputer in the trunk that's required to run the thing, that's, I don't know, like hundreds of thousands of dollars in total. Like part of the whole magic is that we've been able to, compress all of that down to, $1,000 system and sensor that can be cleanly integrated into the roof line of the vehicle. And that's something that's allowed to actually get into consumers' hands. So you're really starting to see next year, you'll actually have a, significant number of, consumer vehicles out on the road. It's impossible to say exactly how many, but we've given our growth trajectory of at least 100% revenue growth year on year in terms of our forecast from what we can see. So you can extrapolate beyond that. But when it comes down to it, for the vehicles, you'll actually see between folks like Volvo and Polestar next year, these are really, the first high volume launches, particularly Volvo with their EX90, of getting this out on the road, because it's not just something that's an option on the car either in the EX90, it's actually standard on every vehicle they produce for Volvo's next gen flagship as part of the vehicle lineup. And then ultimately, just like, with the Mercedes of this world, of how, as we're working with and deploying the technology over the coming couple of years, you start to see proliferation throughout the rest of the vehicle lineup. So, it starts with that initial vehicle model, which is great, but, it's even more exciting once you start to see it go across the rest of the lineup. And then that's where it's not just on the high-end models that's deployed first, but then also across the mainstream models. And you're talking in total, in the millions of vehicles that we have under contract that get deployed over these terms. So Gotcha. It's a pretty exciting time.
You talked about this a little bit on the call, and I just wanted to clarify. You talked about some reports that one of the Volvo vehicles, the EX90, had been delayed in part because of the integration of your tech. But you said that's not really the case. Can you explain to us a little bit further what exactly was going on there?
Oh yeah. It just seemed like there was some confusion or some reports earlier of like, was it like Luminar that had something to do with that, and that's actually not the case there at all. Is that when you talk about vehicle software and other things like, it's really unrelated to our LiDAR deliverables or even our software deliverables there. So it takes time to be able to, for companies to be able to get their EV lineups, up and running and, rolling off the line, so to say. But that was already actually embedded in our forecast for what it's worth. So, we generally are very conservative when it comes down to that and how we're modeling these things out. So that wasn't necessarily a surprise, but when it comes down to it, I think the critical part is, we're continuing to be able to deliver across our milestones, and we've been able to do so consistently. We have obviously a diverse array of commercial wins. We have now more than a dozen major commercial wins across the board. So it's really more than the entire rest of the industry and landscape combined, for major commercial partners in these kinds of deals. So, we're excited to be able to deliver across the board and meeting the milestones for all these various programs. And exciting to see, like I said, some of the new advancements as well for this quarter, which we've had from a commercial standpoint, including also, by the way, a new mapping deal as well. So seeing some of Luminar subsidiaries also like in AI and semiconductors, but now in mapping as well, start to take off.
Austin, when we think about your revenue growth and the financial outlook that was provided for this quarter, you expect at least 100% revenue growth in 2023. And I bring that up because some companies tending to sandbag or at least kind of lower some of the expectations so they don't risk missing on the guidance and the forecast that they're putting out. You're being very aggressive here. What type of margin profile would you expect to achieve? And further down that same thought, how should people be thinking about your company as you do move towards some of these targets? Are you a AI company? Are you a semiconductor company? Are you strictly radar, LiDAR company? What is the annexation that you think investors should be thinking about your company as, and thus annexing kind of a similar type of multiple or valuation?
Yeah, exactly. And by the way, totally fair question. You're like, wait a minute, like 100% growth? That's like, got to be like one of the, maybe even the like fastest growing company on the Nasdaq for this size of business or something to that effect. I think, the reality is, and part of the whole beauty of this kind of business, and I think something that's very underappreciated, is that we've already baked in a lot of that when it comes to, or even the majority of that when it comes to our contracts and how we're able to deliver against those for automotive series production. I mean, we're talking, as of last year, I think we reported around 3.4 billion in our forward-looking order book. So that basically ends up, converting to revenue, 1-to-1, plus or minus as we continue to execute, as people deliver and other stuff, which, by the way, is independent ultimately of the specifics of the timing. But I'm generally, and if you actually look at the history, I try and have a philosophy of, in a world of companies that, overpromise and underdeliver, to try and be the company that will underpromise and overdeliver for this industry. And I think we'll be able to do exactly that when it comes to not just the business milestones, but also the economics. And we're also on track and with a trajectory, not just for that, exponential growth when it comes to, the business side and how that's scaling and ramping up from a revenue standpoint and top line, but then also from a product standpoint, we have 3 key profitability goals that are taking place. So by the end of this year in the fourth quarter, we expect to be gross margin positive, to actually reduce our free cash flow spend by about 50%. As the one-time launch cost start to roll off. And then at the same time, for the core business, we actually expect to be profitable by the end of next year. And even the overall business for everything that we have by the end of the following year. Obviously, I want to continue to make the key investments, for the growth and additional growth initiatives that we have that I think hopefully people can see are already starting to pay off pretty substantially. So we're not crazy on that. But when it comes down to it, we're making it happen and executing to a T.
Austin, good to catch up with you. As always, Austin Russell is the CEO of Luminar. Thank you.
Thank you.
See you soon. All right, guys, all your markets action straight ahead. Stay tuned. You're watching Yahoo Finance. Welcome back, everyone. It's just after 10 a.m. in New York City. This is Yahoo Finance Live. I'm Brad Smith alongside Julie Hyman, and we're about 30 minutes into today's trading activity. Let's take a look at how stocks are moving this morning here, very much in a holding pattern. Deflation in China and an eagerly awaited U.S. CPI print. That's front of mind for investors. We've also got big earnings from Disney. That's coming up from the House of Mouse after the bell.
And we are also watching shares of Wendy's, which reported its second quarter results before the bell, beating Wall Street estimates, but trailing in revenue. The fast food chain saw system-wide sales grow by almost 7%. CEO Todd Penegor saying this expansion in sales momentum drove an over 200 basis point year-over-year increase in U.S. company operating margin. The share's up 1.4%.
All right, the Baconator line items there. Also, we got to talk about Rivian. Rivian shares are teetering today. The company reported earnings after the bell on Tuesday with an adjusted loss per share, coming in narrower than the street expectations. The electric vehicle maker also raised its production outlook, now seeing 52,000 vehicles rolling out this year. We're seeing analysts today with mixed feelings about the report. Piper Sandler maintaining a neutral rating, saying Rivian had a good quarter, but upside potential is tempered by capital burden here. Shares no longer teetering, they're just down by about 4%.
And Upstart shares are spiraling today. They're down over 26% after guidance came in below expectations. The tough lending environment is weighing on the company. That's what executives said on its second quarter earnings call. Growth being constrained by cautious banks and investors who are wary of buying loan portfolios. Well, it has been 1 year to the day since President Biden signed the CHIPS and Science Act. The law intends to rebuild the U.S. semiconductor industry with $231 billion in new investments. So let's kind of get a status report. Quite a few major semiconductor manufacturers have made large investments in the U.S., but so far labor shortages and construction issues have delayed operations. Taiwan Semiconductor, also known as TSMC, has been pushing back the opening of its Phoenix, Arizona factory by a year. The world's biggest chip maker was supposed to start production of chips for iPhones and MacBooks in the new facility next year, but now it looks like the doors will not open until 2025. So joining us now with insight into the future of the program, Aaron Chatterjee, known as Ronnie, former White House CHIPS coordinator. He is now back at Duke University as professor of business and public policy. Thank you so much for being here. We have been watching the fruits of the CHIPS Act very avidly here around the country with all these plans for factories. But it has been sort of a tough road here, in part because of labor to build and staff those factories, Ronnie. So how are you sort of thinking about it status-wise and where we are right now?
Well, thanks for having me. I feel really good about where we're at today on the one-year anniversary of the CHIPS and Science Act signing. I was there when President Biden signed the bill, and he said, today is a day for builders. And we've been building all around the country. $166 billion of private sector investment in the chips industry since we passed the bill. So things are in great shape from that vantage point. There's a lot of interest from the companies in the program. So you're seeing those investments. That's just private sector investment before the money's been handed out. And so now you're seeing over 400 companies, 460 by today's count, that have filed statements of interest to access the CHIPS funding. So I'm confident that that money's going to go out. We're going to have announcements before the end of the year, and you're going to continue to see those projects move forward. The chip business is a cyclical business, and it's up and down. But over the long run, I think we're going to see a tremendous increase in the production of chips here in the United States of America.
Hey, Ronnie, people who are watching are trying to figure out, for the sake of their portfolio, what makes businesses a good candidate or a company the best candidate to get the most amount of funding for a project, and how that goes about being evaluated.
Sure. I mean, when you do a big program like this to invest in a key sector of the economy, you got to be clear about what your goals and criteria are. Already, there's more applications than there is money. And so when you're thinking about companies, you should look at a strategy report that the CHIPS office released in February that outlined the criteria for the program and how they're going to make decisions. And I'll say at the top of that list is American national security. We are investing in chips to make sure our supply chains are more resilient, so we will not have to depend as much on other countries, particularly when they're geographically concentrated in particular parts of the world. And so companies that fulfill those national security objectives are going to be the ones that are going to do really well in the program. That's the number one criteria. There's a list of other criteria in the strategy report that was released in February by the CHIPS program office at the Commerce Department. A key thing we emphasized during the time I was there is we have to be clear about our goals. We cannot do everything for everyone. We need to be very focused and concise in those things. And you can look at that report for more details.
Have any of the applicants, particularly the large companies, been sort of chafing at any of those restrictions that are being put in place, the sort of limits or conditions that have been attached to getting this money?
In conversations with me, they did not chafe at those. I think the issues that you cited earlier about we need to make sure we have the best workforce ready to go on day one to make these factories productive. That's the big issue for a lot of companies that we're working with. I think when it comes to sort of the restrictions on investments around the world, providing benefits and childcare for their employees, these are things I didn't hear a lot about. And in fact, I think the proof is in the pudding. When you think about the 460 statements of interest, that's 460 projects that sort of people in the private sector have said, we'd like to access CHIPS funding. So to me, that's this proof as much as you can have that the program is working as designed and you're seeing that interest as a result.
Are those companies then barred by taking some of the CHIPS funding? Are they barred from doing mass business with other parts of the world and notably areas where there have been restrictions put in place, especially for intellectual property?
There'll be guardrails for the recipients of the CHIPS funding or those who use the investment tax credit with regards to building up leading edge capability, for example, in particular parts of the world. I mean, we need to make sure that as the U.S. government, we're not using our taxpayer dollars to subsidize sort of capabilities in other countries that are going to threaten our national security. And so those are reasonable rules of the road that will be in place for the recipients of CHIPS money. And it's something that I think is really important for the program and a widely shared value across the board.
So the administration has recently talked about major progress coming in the months ahead on the CHIPS Act and the recipients. What does that look like? What does major progress look like in the next, say, 6 months?
Fantastic. So what you're seeing now is private sector investment around the country. You're seeing factories being built, construction ongoing. These are private sector investments that really have been sort of supported by the signal of passing the CHIPS Act in the first place. But the money for those projects hasn't yet been granted. So what people should expect before the end of the year is major announcements about sort of deals that can happen in the economy to support those kinds of constructions around the United States. So you're already seeing fantastic private sector investment. Some of that's because people are bullish on the United States of America. A lot of it's also because they feel like this is the place to build chips in the future because of the CHIPS Act. You'll see announcements between now and the end of the year about sort of those deals going forward. And that's what you want to look for. And that's what the CHIPS office has been working on for the last year.
Are we able to yet quantify what success would look like, though?
Success will mean that we increase U.S. national security by building more leading-edge chip capability here in the United States. We should also be producing memory and mature semiconductors at scale. Those will be sort of decisions that are made in the CHIPS program that will be indicators of success. When you look at our capability, both on the leading edge, logic and memory, as well as some of the complementary activities like advanced packaging, research and development, that'll be an indicator if we build an infrastructure here that we're successful. We clearly outlined this, released it to the public, and people can keep score by looking at the investments that the CHIPS office is making and how it aligns with the objectives we set out. That was something that was really important from the beginning. A lot of times when government's making these large investments in the economy, you don't have those rules of the road. People can't keep score, and in the end, those projects don't go well. We have a clear criteria and a way for people to hold us accountable.
Ronnie, finally, I want to ask you about, on a related note, the report in the Wall Street Journal today that the U.S. is preparing to ban private equity and VC investment in some Chinese tech companies. Of course, this is just the latest in the sort of back and forth that we've seen between the U.S. and China. Is this the right way to approach trade and our economic partnership with China?
Well, I won't get ahead of the White House actually announcing those details because I don't want to comment on the press report yet.
Ronnie, you don't work there anymore. You can say whatever you want.
No, that's right. But I will say, so in my opinion, though, I mean, you look at global trade and you look at sort of the investments that are happening around the world, both in the chip industry and beyond. And I think that you're not necessarily seeing this big retrenchment from the global economy. What you're seeing is reasonable rules of the road being set out. It doesn't make sense for us to be subsidizing investments that are going to increase capabilities in other countries that could threaten U.S. national security. And so I think to the extent that these rules are making sure that doesn't happen, that's a good thing. We do have to make sure that global commerce can continue and investments can be made, and that'll benefit the United States in the end of the day. When you look at those 460 statements of interest from companies, when you look at the $166 billion of investment, that's coming from U.S. companies and foreign companies betting on the United States of America. We got to keep that system going, but we need reasonable rules of the road to make sure that we're not creating the capabilities in other places that threaten our national security. That's what it's about.
Ronnie, great to have you here with us today, and thanks so much for the time, really breaking down some of what is key to making this CHIPS Act be successful here, as well as much more around the industry. Ronnie Chatterjee, former White House CHIPS coordinator and Duke University professor of business and public policy. Thanks so much.
Thank you for having me. Appreciate it.
Absolutely. Well, switching gears here, everyone. PayPal taking a deeper dive into the cryptocurrency space with its own U.S. dollar-backed stablecoin. Customers will be able to use the new PYUSD to purchase products, send from person to person, transfer to other wallets, and they can also be converted to or from other cryptocurrencies that PayPal supports. So could PayPal's entrance into the space lend it some more legitimacy? Joining us now, we've got Brendan Peterson, Punchbowl News financial services reporter. Brendan, great to see you as always here. So help us break this down just a little bit more and PayPal's new foray into its own digital currency.
Thanks for having me, Brad. Yeah, I mean, the big deal here is PayPal itself. I think there's a lot of stablecoins out there, but as far as new entrants goes, there are few fintech companies that are more ubiquitous than PayPal. So having that exposure to a stablecoin-like product for a lot of consumers is going to be significant. Now, that said, there are a lot of obstacles here towards widespread adoption, right? Most vendors at this point do not accept stablecoins. So even if you are, buying a bunch of PayPal's stablecoin at USD, you're going to have to convert it back to that fiat currency most of the time when you actually use it. Now, that could change at some point, but the big thing that we are tracking here in Washington is going to be the role of FedNow. That's the instant payment system that the Federal Reserve has been trying to stand up for a long time and actually launched last month with just a handful of banks. If a lot more banks take that up in the next couple of years, we could see a much lower demand for stablecoins, the type of product that PayPal is pushing right now. But if the government can't get that adoption, it may be up to private actors like PayPal to make that happen.
Brendan, I have to plead some ignorance on this, as I have ever since the concept of stablecoin was introduced and explained to me. Why? Like, what does this do for PayPal or PayPal users? Or like, what is it for? I don't quite understand it, I have to admit.
That's a great question. I mean, one thing that you will hear from a lot of policymakers specifically is they will, instead of just saying stablecoins, they will say payment stablecoins or dollar tokens. That kind of gets at the core function of this thing. For a lot of people, let me say this, for a lot of people, stablecoins are just another speculative investment.
I mean,
right
we
now.
have the dollar already, right?
Correct. But I'll say this, the dollar is not instantaneous, right? Like the slowness of our payment system is behind most other peer countries around the world. And so when you're looking at Mexico has had an instant payment system for decades. Brazil's stood up one pretty quickly in the last decade or so. The UK has one. We are behind on this. Stablecoins are a private way to get instant payments, right? We don't have that at the government level. If we did, you don't need a private sector solution if getting faster payments is really important. And for a lot of people, I should say, faster payments are really important. If you are living paycheck to paycheck and you are waiting for a check to clear on a Friday, you might not get it, depending on how slow your bank is, and you might not be able to pay your bills. So there's definitely an economic case for this, particularly for low-income people. But it's until there's one company that comes along that has a significant amount of scale that can pull this together, or the federal government steps in and has a more functional product, we're not going to really know what this product can do.
Has sentiment recovered enough around stablecoins right now, Brendan? I mean, we've come a long way, many years from PayPal's intentions to even be part of the Libra consortium, and now they're launching their own digital currency. This one is with Paxos, I believe, and so this, of course, also still comes after much of the algorithmic stablecoin kind of debacle that ensued. So has stablecoin sentiment rebounded well enough?
I think it depends on who you ask. I think in general, yes. There is at least widespread expectation or anticipation from policymakers in DC that we need to do something about stablecoins. There is a fair amount of like systemic risk that can get attached to a large enough stablecoin, because you're talking about the creation of private money, and that can create funky things in an economy when it's not controlled by a centralized authority like the Fed. With that said, Republicans in the House are pushing really hard on stablecoin legislation. They just cleared a package through a markup on the House Financial Services Committee that would introduce first of its kind stablecoin regulations, and that had some, although not all, of the committee's Democrats supporting it as well. About 7 Democrats out of 20-something supported that bill. So in terms of acceptance, we're getting there. But I think to Julie's earlier point, the question really is like, what is this for? And are people going to bother to go through all these hoops to figure out how exactly to deploy a stable coin and how to convert it back and forth when all you're ultimately getting is money a couple days early?
Brendan, thank you so much. Brendan Peterson, Punchbowl News financial services reporter. Good to catch up with you.
Thanks, Julie.
All right, let's do Check the Markets, sponsored by Tasty Trade. All 3 major averages are trading lower right now. The Nasdaq leading declines off by about 0.5%. The S&P and the Dow are really little changed in today's session. Again, a little bit of maybe water treading ahead of CPI tomorrow, but also, of course, we continue to sift through earnings. In a major shift for the gaming industry, Penn Entertainment and Barstool Sports have gone their separate ways. Founder Dave Portnoy announcing he once again owns 100% of Barstool. Penn, on the other hand, has entered into a new partnership with ESPN. The 2 brands are going to launch their own branded sportsbook dubbed ESPN Bets this fall. With more on this, we're joined by Chad Bain and Macquarie's senior gaming, lodging, and theaters analyst, our Josh Schaefer, who's been covering the story, also with us. So, Chad, what do you think here? I mean, this sort of hit us big yesterday when the news came out. It was a surprise, even though ESPN has been sort of moving in the direction of some kind of branded sportsbook for a while. Is this the right partnership for Penn and for ESPN?
Sure. Thanks, Julie. Yeah, huge surprise here. On the first side of the surprise, Penn has been committed and kind of backing up the personalities from Barstool, and obviously that came to an end, as you mentioned here. In terms of ESPN, it has been out there that ESPN has been looking for a partner for several years. They had arrangements with Caesars and DraftKings, really just kind of on the media commitment side. Neither one of those companies went all in with Disney or ESPN. And this deal is an all-in deal, right? You know, up to $2 billion of commitments for 10 years. And on the earnings call, which just ended about 20 minutes ago, Penn CEO Jay Snowden talked about why this is the right fit. And they believe that they can get $500 to $1 billion of profits. That's currently about what the company does on the land-based side. So this is a huge decision for the company and the path of the stock over the next couple of years.
And Chad, what's this mean for the industry as a whole? You take a look at DraftKings shares down about 9% on this news. I think there's sort of 2 reads you could get. You could say this is, a massive move for the industry and sort of like a changing of the guard, maybe in some sense of how we're going to look at this. But maybe that's too big of a read too, and people may be overreacting to the news. I'm curious what the read is.
Sure, Josh. Yeah, the skeptics will continue to point to some of these media partnerships have not worked out as expected. The Fox situation, Fox originally expected to get 10 to 15% market share. Then you had PointsBet tying up with NBC. They were expected to get double-digit market shares as well. Everyone was looking at the UK model and what Sky Bet had built over there and the success. So after we saw some of these media deals not work out as expected, I think there's been just more questions around if this is the right way to acquire customers, maintain customers, and are you able to hit the goals? In terms of DraftKings being down right now, I do think that it's probably a quick reaction here. DraftKings has been up 180% year to date. They had a great quarter, generated $70 million of profits in Q2 when they were expected to lose money. FanDuel reported this morning they generated $100 million. So between those 2 companies, look, they're still over 70% market share. I think they've done incredible things on the tech side and the customer retention side to certainly, state their case that they're not going to lose market share to ESPN Bet.
Does the ESPN Penn deal make an ESPN spinoff from Disney a no-brainer for Bob Iger?
My colleague Tim Nolan covers Disney, but as he's written about, and I think Bob Iger has talked about, I think this is something that many expected could be in the cards here. It is a small deal as a percentage of Disney's total market cap. I was looking at that this morning, right? You still have a market cap with Disney in the hundreds of billions of dollars, and this is a nice commitment. And they do have some economics on the tail end if it's successful. From what Penn said on their call this morning, it sounds like they do have a lot of control with the personalities, with the content, and there will be a board seat from ESPN on Penn's board. So certainly it looks like they're tied up as close as they could be, and that could lead to a change for Diz.
The tie-up maybe was a little too close when it came to Barstool and Penn, right? I mean, was Dave Portnoy just too toxic to be partnered with a publicly traded company? And is there any chance that anybody else would touch Barstool at this point?
Yeah, that was part of our positive thesis on Penn, and it had been trading in this $25 range. Even if it wasn't going to work out with Barstool, we still thought that there was value there, and Penn could actually sell this off for $500 to $1 billion, get their money back, and then some. Parting ways without getting an inflow on the financial statements was a little bit of a surprise. They still would benefit in a Dave Portnoy Barstool sale to somebody else. Penn would receive 50% of the proceeds.
But who else would buy it, Chad?
There's certainly some players that are currently in the space that have been talked about, but now after we're seeing the regulation friction with these individuals, that makes it much more unlikely. It just sounds like the team over there at Barstool wasn't able to operate as they had for years if they were in a highly regulated industry like we are on the land-based gaming side. So yeah, there's not many likely partners on the sports betting side. The media business has done well. That's doing $250 million of annual sales. When Penn originally bought into the deal 3 years ago, it was doing about $100 million of sales. So the straightforward media business has doubled, even though it's not making a profit. So I would think it would be a traditional media partner that would make more sense than a sports betting partner.
And Chad, with the ESPN bet deal, Penn was talking on the call about how it might be a little bit different than some of the past media deals. You pointed to earlier that they're going to have more control over the talent. It seems like the talent might be calling out ESPN bet maybe a little bit more than they did with Caesars or DraftKings. I'm just curious if this deal feels different to you than what ESPN has done in the past from that sense.
Yeah, Josh, a little bit, but I still think that ESPN has actually done a pretty good job pointing people towards sites and obviously giving their take and their some of the interesting parlays. Other networks have done a really good job. The TNT and the Charles Barkley team has been pretty successful in that. So there will probably be more of that. I'm not sure if ESPN was holding back from the commentators actually previewing a game with all the interesting same game parlays. So I'm sure some of that integration will be made ahead of the football season, and Penn said the launch should be around November. I think that'll be a key point, and it sounds like that was a big difference between the media groups that had been successful versus ESPN, which was providing a little bit more of just the odds and not as much kind of in the details in terms of where people are placing their bets right now.
Chad Bainan, Macquarie, senior gaming, lodging, and theaters analyst. That's a lot. Alongside Yahoo Finance's Josh Schaefer. We know you've got a lot to really busy up your day from here, so thanks so much for taking the time, Chad.
Thanks. Appreciate it.
Absolutely. All your markets action straight ahead. Stay tuned. You're watching Yahoo Finance.
What do you do outside of work to help keep your head on straight?
I love to read. I think anyone who's in this business just has to drink from a fire hose and read a lot. And I'd like to try to read a lot of different Thanks.
What are you reading right now?
So right now I'm reading David McCullough's book on Truman. So I thought it was kind of an interesting, and I swear I didn't make it so it was coordinated with Oppenheimer, I promise. But it was kind of an interesting period of time, and Truman was an interesting character. So a little bit of history right now.
And you saw Oppenheimer already?
I did see it. Yeah, I thought it was very good. I don't know why anyone can't tell a story in under 2 hours, but other than that, I thought the movie was great.
Shares of Roblox under pressure this morning after reporting a wider than expected loss in its second quarter. The company had net bookings of over $780 million and a loss per share of 46 cents. Joining us now, we've got Michael Pachter, Wedbush Managing Director of Equity Research. Michael, great to see you. Great to speak with you and grab some time as always. We've got a lot of video game companies that just reported earnings. Let's start with Roblox here. I want to get your high level take.
Their revenues are fine and their user base is growing. They're doing all the right things on the top line. They're just not as profitable as I think a $20 billion valuation implies they should be. And, in fairness, they actually told us they wouldn't be. They told us that they had intentionally, made the decision to invest in people and to expand, their safety, security, headcount, and to try to grow the business. So they're investing in growth. They told us to expect single-digit profit margins. They had delivered, the 30s pretty consistently, then dropping maybe to the 20s through 2021. 2022 was 12%. So when they said single digit, I think the street read that as 9%, and it came in at 4.9. So they really surprised people with how bad their profits were. And again, by design, I don't think that there's any surprise here to the company. It's just a surprise to investors because people didn't take the CFO's warning seriously.
So what does Roblox need to do now? I mean, forget about the management of expectations. What do they actually need to do to boost back those margins and to try to forestall some of this either stagnating or even declining user growth?
The user growth's fine, and I actually don't think that we should worry about that. They're managing the business well. So they in fact, they're going to grow the way TikTok's going to grow. 13-year-olds are going to turn 14 and continue to use Roblox. So I'm not worried about, people aging up and continuing to play. They'll give people relevant content. What they have to do is take a page from the Andy Jassy playbook, and Jassy really blew it for about 6 quarters at Amazon, investing in stuff and underwhelming on profit, and they watched their profits decline and their share price get cut in half. He suddenly decided to deliver profitability, and as soon as he did, look at Amazon, it ripped. So if Roblox takes a page from that and says our shareholders matter, our employees matter, and all those people get compensated when our share price goes up, then I think they're going to deliver higher margins, and I think the stock will go up. Is that going to happen next quarter or the quarter after? Probably not. So we've been neutral on this thing for the past year because we actually took management seriously that they weren't going to deliver increasing profit. Anytime they want the stock to go up, let's start increasing profit.
So it sounds like, even though you've been neutral for the past year, that the reality might lead you to kind of change that rating in the near term if management doesn't change?
Yeah, I would love to be able to take that bait. Every earnings call is a new exercise in reviewing the model and thinking about it. If I knew what was going to happen, then I would have the perfect rating all the time. You, Brad, will remember I had to sell on Netflix for 10 years until I was proven right. So I'm pretty stubborn, and I like to see proof that things are turning around, and I did see that at Netflix, which is when I upgraded. I can't talk about my prospective rating until I have a note out later today.
Let's talk about the bigger video game universe then, because we got Take-Two numbers as well. I wonder if you like them any better at this point than you like Roblox. Those shares trading lower by about 2% today, and those numbers missing estimates a little bit as well.
Yeah, Take-Two is a really interesting story. And again, I've been around for over 20 years. They did this exact same thing back in 2011. They had a bad year coming in 2011. So when they got into a bad year, they said, but GTA is just around the corner, and the stock started to rip. They did the same thing this year. They never said the word GTA or the letters GTA, Grand Theft Auto. But they said, our revenues are going to be $5.5 billion this year, and then magically they're going to be, $8 billion next year. Well, they can't grow $2.5 billion without Grand Theft Auto. So the plain implication is Grand Theft Auto is coming next year. I actually don't think it's coming. I think it's coming the year after, because they just have never delivered that thing on time ever. But with that said, it's coming. It's in development. It's close. And so investors are pricing that in, and the stock's going to stay up. I don't think they can do anything to make it go lower. And the beauty of Grand Theft Auto is they have a really robust free-to-play business, online business built around Grand Theft Auto. If they start leaking out content on the online business that's going to be in the premium game, I think you will see their subscriber base grow by tens of millions, each paying $10 a quarter, $40 a year. So I could see $400 to $800 million of incremental revenue annually just by leaking out GTA 6 to their online subscribers. So again, the company is very well positioned with great content. I actually love the management team. They are the smartest in the business, and they don't tell anybody anything, which allows me to stand out and have these opinions because they won't announce anything.
So can NBA 2K then sustain until a new GTA comes out?
That's like asking if McDonald's hamburgers are going to keep the company afloat when everybody else has chicken sandwiches. I mean, it's their staple. So yes, of course. But, people are looking at the bright new shiny object, and that's Grand Theft Auto.
Right. And for the growth that a lot of investors are looking to see.
Right. You're not getting it from NBA. You're going to get it from GTA. NBA will allow them to grow by 1%. just not meaningful enough to drive overall top line growth.
Michael, how does, just to go in a little bit of a different direction here, how does the Activision-Microsoft deal affect the competitive landscape for these other guys?
I think that the upshot of Activision Microsoft is that Game Pass is going to become a much bigger business. And Game Pass is a subscription streaming service that Microsoft offers 25 million users. And to put that in context, there's about 250 million regular console gamers and about 400 million regular PC gamers. So if that subscription offering becomes more valuable, it's likely that fewer people will buy consoles in the future. And the companies that are leveraged to selling games only on consoles, like Take-Two and EA, not only, but primarily, they're going to have a smaller installed base to address. So they have to adapt as well. Microsoft will pay up for the content, but this is sort of like talking about, broadcast television reliant upon cable, and people are cutting the cord for streaming services. What do? And their mistake was they supported Netflix. I don't think anybody's going to support Microsoft, but I think these companies have to come up with alternative business models. And as I said, Activision is the best in class at managing their IP, intellectual property, across different distribution. Take-Two second. They have a really robust mobile business. They have a really robust PC and console online free-to-play business, and they're getting great at advertising. So I actually like Take-Two the best of the survivors because they'll adapt and they'll figure it out.
What is the next leg of growth in terms of medium for the gaming community, for the number of companies that you cover, and especially with the profile of gamers right now and kind of the demographic, or the makeup, I should say, of the community? Because I think that's what investors are trying to kind of lean into to figure out how they can see, to the best of their ability, into the future, and how that revenue and the margins on top of that are going to be generated. Because we're hearing less about the metaverse. We're hearing more about what AI in gaming might look like and all of these other things. So what does that
Metaverse is coming, but the the gaming community was probably 500 million people back 20 years ago. And then mobile phones turned that into 3.5 billion. So you're going to get that kind of explosive growth if you provide access to people on a device that they already own. And that means game streaming is the next great opportunity. How many middle-aged men would love to play FIFA, but that's the only game they care about, and they don't own a console, or they don't own a high-end PC? They could play FIFA on their TV, streaming from their internet router. You're going to sell an extra 20 million copies of FIFA. So I really think Game Pass is the answer. And it's the same as Netflix. Like, Netflix has 225 million subscribers because it's easy. You turn it on, there's a button on your remote. It's so easy. So I actually think that's going to be the game changer. And I think a couple of billion people are going to access console games instead of 300 or 400 million over time because of services like Game Pass.
Well, I've played the trivia game on Netflix, but that's about it so far, Michael. Michael Pachter, good to see you. Wedbush, Managing Director of Equity Research. Thank you. And in the next hour, we're going to be talking more about AI. Our very own Rochelle Akufo is going to be diving deep with Nina Schick, author, advisor, and speaker who specializes in generative AI. Meantime, we've got much more coming up. You're watching Yahoo Finance. Now that Fitch has downgraded the debt of the U.S., I'm prompted to ask where you were when S&P downgraded U.S. debt in 2011 and kind of what your reaction was at that stage.
So I was in London working for State Street Global Advisors at that time, and it was kind of just in the aftermath of the global financial crisis, Lehman Brothers going out of business. So the world was still exiting a very difficult period. So I think today is a lot different. The economy's growing, and times are a little bit different. So the fact that we got downgraded certainly is a disappointment and perhaps not surprising, but I do think times compared to then to now are a lot different.
Dutch Bros brewed up an earnings beat in the second quarter, but revenue did come in just shy of estimates despite a 34% jump year over year. The coffee chain also raised its full year guidance and says it is targeting 4,000 shops over the next 10 to 15 years. Joth Ricky is Dutch Bros CEO. He joins us now alongside Yahoo Finance's Brooke DePalma. Joth, when we talk about that growth, talk to me about what the right pace and strategy for growth is, because I believe you guys learned some lessons this quarter about how you deploy new shops and where you deploy them.
Yeah, I think we've been working on pace for 5 years, and I think that every year we've tried to grow our capacity as an organization to continue to build into the new markets and the new states we've gone into. I mean, in the last quarter we opened 38 shops in 8 different states, and some of that is about how do you go into markets? How do you think about your infill rate? How do you think about the growth of your people and your supply chain and all the other things that go with that? So we're on this pace. We're going to have some really great outcomes, and we're going to have some things that we learn along the way. And I think the most important thing, as you mentioned, is you take those lessons, you learn from them, and you continue to apply them to building your business and understanding that you're building to the 4,000 shops. It's not just about the 38 that we put in place last quarter.
Good morning, Joth. When you think about really the future design of Dutch Bros, I know that there's some different shop formats. Is there one that performs better than others? And can customers expect an entirely new format on its own?
Well, I think that over the 30 years of this company, I think that we have evolved our shop format. We've evolved the way that it looks, the size that it is, the way that it could handle the capacity of customers that we have. So, you're not just managing, in some of our smaller markets, our shop footprint is very small. In some of our new larger markets, like in Oceanside, California, or some of the things we have in Texas, you have to build out a much larger footprint to be able to handle the traffic that comes through the line. So I think the beauty of what we've done is we'll continue to evolve, and we'll continue to learn about customer expectations, how technology plays into that, how we continue to refine the inside of our shop operationally to make sure that it's efficient as possible to manage for the future. So, I don't think you ever stop thinking about how you design what you do, and you continue to work on how consistent improvement over and over and over.
And Joth, I want to dive in a step further. You did mention technology being used to speed up your lines as well as help with that traffic. What sort of technology are you using? And I know we talked about AI a bit last quarter, but is that being used on the back end of things at Dutch Bros?
Yeah, not extensively at this time. I think we're being smart about how we look at and how we implement new technology across the board. I think that I think we all agree that technology is an ongoing investment. You never really stop, and there's no moment in time. I think that we're with the launch of our rewards program a few years ago, I think that's helped us with technology in the line. It's helped improve flow through in our line. It's helped, I think, improve the customer experience and our ability to communicate with customers. It was a big part of how we drove traffic in the second quarter, and I think our team is getting better at understanding how we do that. Really every day across all regions, whether it's a 30-year-old market or one that's brand new. I think we've talked before. I think AI is inevitable as you utilize it in your business. I think you just have to be careful about what you do and how you do it, and make sure that it enhances the business versus replacing things that may not be necessary.
Joth, when I think about Dutch Bros and all of the great drinks you got, I also think about what I'd like to eat with those great drinks. And I got to ask about the goodies here. You got the chocolate chip muffin top, and that's gaining a lot of traction in our studio particularly. When you think about all of the different elements that go into making, not just driving menu innovation, but also adoption among consumers, what are you seeing among your consumers right now in their propensity to spend and the ticket prices particularly, and adding on the famed muffin tops to one of the great beverages?
Well, food is only about 3% of our business, and we've been careful about food. We have a small footprint. We have a customer experience that's really driven through beverages, and food is an add-on, but also, we like the profitability of this model, and our ability to be profitable allows us to continue to invest in that innovation in drinks and the things that we want to do. So, the team's been playing around with different snack items that help, I would say, accommodate the drinks that we have and the occasion that people shop at Dutch Bros in. But, I think that, we like muffin tops because nobody really likes the muffin below the paper. You just like the stuff on top.
It's a fact, Job.
Yep. So it's so we think that's a brilliant move by the team, and it also is a fun way for us to continue to really promote what Dutch Bros is all about.
Okay, so what's beyond the muffin top then? What's next? What's being tested right now?
You look at, we're looking at different snack options. We're looking at different occasion options that are easy to eat in your car because, right, we're 100% drive-through. So we've got to think about if somebody's buying a drink for immediate consumption, they're probably buying a snack item for immediate consumption. And so we've got to think about, what really serves the purpose of a car experience that's simple to eat, easy to have in a hand. And you can't get too big in that. And you really have to think about that it's something that's going to be consumed while somebody's in the car. So smaller items, smaller snack items, think about different day parts of what people are looking for, maybe in midday or maybe an afternoon snack.
And Joth, quickly, I want to weigh in on the back end of things. Ingredients started to moderate, cost-wise this past quarter. What are you seeing more expensive at the start of this new quarter? And ultimately, what plans do you have to sort of moderate these ingredient costs in the rest of the half of the year? I know you hinted at some higher pricing this coming quarter.
Yeah, we have seen some moderation. It's been about a 1% moderation in cost of goods. I think that's really across the board. I don't think we're seeing anything that's running at the level that it was and things that we were talking about a year ago. I think now it's about, I think people are settled in, if that's the right term, as far as how costs of goods are laying out, and we'll see. We did take some price action, but some of that was more related to how we rebalanced our pricing zones and how we looked at modifiers on our drinks to be able to support some of the customization and the premiumization that the customer is looking for. So, we'll look at that. I think that the price action we took is somewhere around 4%, and it will. We'll just see how the rest of the year plays out. I think there's some uncertainty related to, rates and how we might see cost of goods flow through the balance of the year. So we'll manage it and adapt as we need to.
And Joth, on that note, just any ingredients that you're seeing in particular, is it sugar costing more? Is it, sauces or syrups on the back end? What sort of ingredients are costing more these days?
Well, I think, the cost escalation that we experienced a year ago in dairy, and you've seen some sugar, prices go up, and you've seen, kind of across the board, you saw a pretty big spike, especially with dairy. None of that has come down nearly to the degree that it rose. And I think, we're really planning on those items stabilizing, and we're managing our business for a stabilized, cost environment right now. But like I said, I think that other ingredients could move, but we're not seeing that right now.
All right. Going to be watching out for those goodies. Joth, thanks so much for taking the time here today. Look, my bet is on cinnamon rolls. I'm just going to throw that out into the ether, and if all else fails, you can just crack an egg in somebody's hand in the drive-thru and call it the Rocky Meal. Who knows? Joth Ricci, who is the Dutch Bros CEO, alongside Yahoo Finance's Brooke DePalma. Thanks so much.
Thanks, you guys.
I could have sworn I would have bet that you would have bet on a croissant, because I know a croissant sandwich is.
No, it gets flaky. It gets too flaky.
In the car, you get it all over yourself.
Yeah, your car's dirty after you have a croissant in there.
I wasn't thinking of the car aspect of it. Let's get a check of markets before we leave you, shall we? What's the croissant trade looking like today? Not so good.
It's looking flaky.
Looking flaky indeed. The Nasdaq down 0.9%, leading some of the declines.
Yeah, it's crazy out here, man. All right, Dow Jones Industrial Average, S&P 500, and the Nasdaq all in the red. We'll see how things continue to move forward from here. We got a lot of time left on the clock here in today's session. Rochelle Cupo has you for the next hour.
Welcome to Yahoo Finance. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Rochelle Akufo. Here's a look at what I'm watching this morning. Shares of Lyft are leveling out after sinking in early trade. We'll get a pulse check on the earnings call coming up this hour. And the House of Mouse is closing out earnings season for the media giants after the bell today. We'll break down what investors should expect from Disney. Plus, Nvidia is doubling down on simplifying generative AI, how this could change the tech landscape coming up this hour. But first, let's take a look at how the major indices are faring here. Looking at negative across the board here, all three major indices under some pressure this morning. We see the Dow there just slightly down, about 0.1% on the day, about 36 points. The S&P 500 they're also down about 1/3%, or about 15 points. As we look at the strongest sectors, at least energy leading the charge. Tech, though, on that struggle bus. And with that in mind, we take a look at the Nasdaq there, down about 1%, or 136 points there. We're seeing Nvidia and Broadcom under some pressure this morning. Let's also check in on the Treasury market as we await that all-important CPI data coming out. We've got the 5-year down about 0.15% there, just barely. But taking a look at the 10-year, ticking up from yesterday, still above that 4% threshold, but down about 1/3% right now. And the longer-term 30-year yields also down about 0.5% as well. Well, stocks largely muted this morning as all three major indexes are looking to shake off losses driven by banking sector worries. Well, now all eyes are looking to July's consumer price index data, which is set to hit at 8:30 a.m. Eastern tomorrow. Now, the looming inflation report has investors wondering whether or not markets are in for an unpleasant surprise. Let's bring in Marvin Lowe, State Street Senior Global Macro Strategist, to weigh in on this. So, Marvin, what are your thoughts, given the sentiment leading up to this, and especially what we've seen in terms of the Fitch downgrade for U.S. credit rating, some of this creditworthiness issues that we've seen with Moody's downgrading of the banks? What are you expecting tomorrow?
Sure. A lot to chop through for an August summer. So, we have access to some online pricing data. Our online pricing data is showing, a little bit of a mixed signal. There's a little bit of an uptick near the end of the month, but at an industry level, it's seeming pretty stable. So I think in line is probably where we're expecting tomorrow. Every data point is important. We've kind of seen how the markets have been moving on these data points. So, certainly there's probably going to be a bigger market reaction if we see a tick up inflation, because the broader story has been that it is moving in the right direction. But, at the moment, 0.2% for the month over month data is what we're looking for.
And how much of some of the jitters that we're seeing are going to end up doing some of the Federal Reserve's sort of tightening for it, as there is this sort of trepidation about what happens next?
Yeah, absolutely. I mean, the market has gone all in its view that for the most part, the Fed's going to be done. And it really is looking forward to a normalization of that higher policy rate. How we get there is kind of where the debate is. Does a recession push the Fed into cutting rates, or does a soft landing let them more naturally do it? So September is still alive. They've been pretty consistent in saying that every meeting is live. They still have one hike that they expect to do based on some projections they put out in the middle of the year. So having said that, if we wind up with a hot print, it does bring September back on the table and kind of probably revitalizes the story that the Fed might not be done yet. Right now, market pricing is really looking at the Fed being done, though.
And I mean, as we look at some of the flows that we're seeing, we are seeing more liquidity coming off of the sidelines. But what kind of flows are you seeing from institutional investors, and where are they putting their money to work?
Yeah, for sure. So we have access at State Street. It's wonderful to a lot of data that's part of our custodial business, and we have seen a lot of that money coming off the sidelines. Our institutional investor indicators shows one of the biggest increases that we've seen after kind of this real money set had been negative for the better part of this year. So kind of that fear of missing out is definitely pulling money off of the sidelines. From an asset allocation perspective, we are seeing it moving out of cash into equities, and just kind of having sat in the seat for a while, this momentum that often makes its way in the market has a tendency to last longer than you expect. So, that's certainly encouraging for the bulls, but valuations where they are always kind of keeps you a little bit concerned that any bad news print or any bad data print is going to kind of change the narrative quickly.
And, you know, we're looking at this sort of shift from a hard landing to a potential soft landing. We spoke to Christina Hooper from Invesco. She sees more of a bumpy landing, sort of, you know, it's not going to be smooth sailing either way. Yeah. But in terms of the recessionary catalysts then that you think investors might be missing, or which ones are you keeping an eye on?
Yeah, you know what? So the data has certainly been encouraging, and risk assets have ultimately been right. The data has been better than expected. So you could say that the markets were once again right and ahead of itself. I still think that we've got a bumpy road ahead of us. You know, I do think some of this credit stories, the credit tightening that we continue to see, some of the credit card data that was released yesterday in terms of a record number of credit cards. Having said that, we see default rates going up. So, you know, I think that still is in the background. I view that as one of the more important stories, which, if you kind of look at the banking sector, seems to have been pushed to the background. But overall, credit creation is important for this economy, and I think that it becomes a challenge whether or not we're going to see the degree of credit creation that justifies the valuations a lot of these risk assets have kind of priced in.
And we know that there was certain low expectations coming into this earnings season. Yeah. But as we begin to sort of digest some of these bellwethers that have been coming in, how are you feeling about earnings season? And have you seen any surprises at the moment?
Yeah, I mean, certainly, you know, the whole cut expectations and then beat was you know, on full display. We could say that for the better part of this year. You know, we started this year thinking that earnings were only going to grow in the low single digits. We're probably going to shrink by the low single digits. So, you know, all in all, given the concerns, that's a win. We go into next year where expectations are double digit, looking at 10, 12% growth, expecting that 10 to 15% growth, if you will, going into the year after that. That metric's a lot harder. So, you know, certainly looking for sectors that are able to maintain their margins, sectors that might have some revenue upside associated with it, and really kind of positioning for a potentially, like you said, more bumpier type of landing going forward.
And then obviously we're keeping one eye on what we've seen with some of the data coming out of China and the deflationary pressures there. In terms of some of the issues outside of the US that investors should be at least mindful of in terms of how it might impact investments in the US, what are some of the standouts on your list?
Yeah, for sure. You know, the China story always is front and center. It does look like they have a lot of wood to chop. It does look like it's a hard go for them. They've been slow in their stimulus. There's probably a reason for it. It's harder for them to stimulate kind of given where the economy is at that point. And all of that does flow into either the region. So, you know, a lot of Asian markets are very tied to China. And then if we were to think about it beyond that, certain developed market regions are more reliant on China. Europe kind of comes to mind in terms of a closer relationship than what we have here. The positive side of it is that from a goods deflation, disinflation, however it evolves perspective, it does kind of help this inflation story. So which markets might benefit the most, particularly on the goods side of things, if China's deflation does make its way into their exports?
We'll certainly be keeping an eye on that. Great to have you on the show today. Marvin Lowe, State Street Senior Global Macro Strategist. Thank you for your time this morning. All right, taking a look at Lyft reporting its Q2 earnings yesterday, with revenue figures coming in line with estimates and a rosy Q3 outlook, initially sending the stock up by as much as 14%. However, that bump in the stock didn't last as shares fell during and after the company's earnings call. So Yahoo Finance senior tech reporter Ali Garfinkel is here with more on Lyft's earnings call. So Ali, what happened on the call that sort of shifted the winds here?
Rochelle, I got to tell you, the stock here has the shape of the top of a roller coaster. We saw that initial excitement based on revenue wins, outlook, active riders, and then that pullback on what are frankly a lot of outstanding questions that people, the market, company watchers still have about Lyft. And a lot of those were in full display on this earnings call. I want to walk you through some of my key takeaways here because they highlight a lot of the concerns about Lyft sort of moving forward. The first one surrounds pricing. Lyft wants to nix surge pricing. Now, remember, this is part of a broader picture, right? The thesis for Lyft is that they're attempting to beat Uber on price so that they can gain some market share. It's a differentiator, essentially. One of the most interesting things about pricing that struck me in this earnings call is CEO David Risher kept using the phrase customer obsessed, which is a little piece of linguistics that is taken from Amazon, actually. However, there is also the other problem, which is number two, that Lyft can't only compete on price. They were a little evasive about what their plans are in this respect. project, but their plan sort of amounted to two things from what they were telling us. The first was non-emergency healthcare, the idea that you're going to take Lyft to non-emergency doctor's appointments. They're not trying to replace an ambulance, but they do want to take you to see your podiatrist, for example. The other one that they sort of called out was sort of B2B. The example was transportation on college campuses. So that was sort of, for them, what they were willing to give us about where they see the product differentiation as compared to Uber. And the last one is cash burn. Cash burn has been a problem for Lyft. It came up in this earnings call, and Lyft CFO Erin Brewer, her message to analysts was essentially, we're working on this, it's a priority. However, I want to give you a sort of staggering statistic here, Rochelle. Lyft IPO'd in 2019, and in the 16 quarters, excluding this one, that they've been on the public markets, by my count, they've only been cash flow positive in 3 of those quarters. So this is existential for Lyft. Ultimately here, Rochelle, I'm going to give this a vibe check a 3. There's some green shoots here. I think there is something to be really excited about in terms of them moving in the right direction if you're someone who really is bullish on Lyft. However, I was not persuaded by what they were saying about the product and the fact that there is a fundamental sea change that definitely needs to happen in the company.
It's true. I mean, especially, Lyft often being called Uber's little brother. They really are determined not to get into the same sort of food delivery business that Uber is, doing very well with. But they did report some key wins this earnings season. So how does that improve their position?
I'm going to be completely honest with you, Rochelle, here and say that I was actually up at 4 a.m. thinking about this question because I think they're in this between this proverbial rock and a hard place. Think about it, right? So on one hand, right, they are seen as Uber's little brother, and quarter in, quarter out, they need to meet or exceed the expectations of the street just to stay in the game. On the other hand, if there's anything we learned yesterday, meeting those expectations alone is not enough, especially when the company itself has the kind of cash burn problem that it does. At some point here, in my view, Lyft is going to have to raise some money, and that's going to be incredibly difficult in this environment. It's not a matter of, I think it's not a matter of if, it's a matter of how, when, are they selling shares, are they going to do a capital raise? I think that could even happen personally as soon as 2024.
I mean, certainly going to have to see something. If you're going to be Uber's little brother, you better, bring the revenue with it. Thank you for that breakdown, our very own Ali Garfinkel. Thank you as always. All right, well, I'm keeping my eye on Twilio stock this morning. Shares extending their gains from Tuesday after reporting solid second quarter results and raising its full year outlook. The tech company now expects annual adjusted income to be between $350 million and $400 million. Now, this comes as the company has been focused on improving profitability, announcing 2 rounds of job cuts over the last year, bringing their headcount down about 29% from a September peak. Now, bullish analysts have been buoyed by the report. Barclays and Bernstein both boosted their price targets by $10. William Blair wrote in a note that they view Twilio's, quote, execution towards near-term profitability positively. All right, well, we still have all your markets action still ahead. Stay tuned. You're watching Yahoo Finance.
It's been a wild year in the retail space. Inflation has dominated the headlines, causing shoppers to spend more cautiously.
As a result, profits at major retailers such as Walmart, Target, and others have come under pressure.
Organized crime and a growing list of bankruptcies also continue to cast a shadow over the entire industry.
But what does this all mean for the future of the sector? Should investors dive in or steer clear of retail stocks?
We'll bring you key analysis and hear from some of the biggest names in the industry to answer key questions.
Who is the consumer visiting? What can retailers do to stop the rise in theft? Are more bankruptcies on the horizon? And where does AI fit into it all? It's all part of our week-long special, Retail Evolution, The New Era, starting Monday, August 14th, right here on Yahoo Finance. You won't want to miss it.
Let's do a check of the market sponsored by Tasty Trade. Still seeing these jitters as we're looking at session lows, and some of these major indices still bouncing around those session lows as we're just more than an hour and a half into the trading day. The Dow now off about 1/3%, or about 120 points. The S&P 500 also down now about 0.5%. They're down 24 points. The Nasdaq also gaining on those losses as well, down 173 points right now, or 1.25%. Still that pullback as we await that all-important CPI data that we know is key for the Fed. Well, the month of July saw an impressive influx of assets in many of the largest known ETFs, with investors pouring in $61 billion. iShares Core S&P 500 ETF pulled in $11 billion, the Vanguard ETF $3.9 billion, and the Invesco QQQ Trust added $3.7 billion. But there are several lesser-known ETFs that saw unexpected demand throughout the month. As part of the ETF report brought to you by Invesco QQQ, let's bring in Vertify Head of Research Todd Rosenbluth to discuss this more. Good to have you back on, Todd. So some of these ETFs that have been flying under the radar but doing well in July. Let's start with some of your top picks. I want to start with JPMP. That's JP Morgan's USD Emerging Markets Sovereign Bond ETF. What was the catalyst there?
So what we saw is investors have been embracing risk, or they did in July. It was more of a risk-on environment. Investors got more comfortable looking out for yield, and JPMB saw really strong inflows at the end of July, and it continued in the early days in August. Now, this is an ETF that provides emerging market, high-yield, fixed-income exposure to countries like Brazil that are more commonly found in an emerging markets ETF, but also countries like Oman and the Dominican Republic are some of the larger exposures. This is a more filtered ETF from an emerging market exposure than iShares EMB ETF. JP Morgan has some screens to try to make sure that investors have a better understanding of the risks that they're taking on from a country perspective. And as you noted, we've seen some of the big boys within the ETF industry, big boys and girls of AGG and QQQ, among others. But it's just exciting for us at Verify to dig into some of these up-and-coming ETFs that we've seen pop up in flows using our Logically data.
It's true, because you see a lot of interest in emerging markets, so people are not really sure, how to approach it. So obviously ETFs are a good way to get into it. And of course we have to talk AI, because we've seen that pop up in every earnings call, as we knew we would. So let's talk about AIQ there. Let's talk about that one and what some of the holdings are showing us for people who are trying to get into this space, but perhaps a little more cautiously.
So the benefits of using a diversified ETF like AIQ spreads that risk around. So this is a mega trend that we at Verify have been seeing and seeing investor interest and advisor interest on our Verify platform. It's one of the reasons we at Verify are having a symposium at the end of the month, an AI symposium. Folks can learn more about that at ETF Trends. But Global X's AIQ ETF, which is an artificial intelligence and technology ETF, it owns some of the heavyweights within the growth space. So Amazon and Alphabet, those are not technically technology companies in many ETFs. And it has exposure to other companies up the food chain and up and down the food chain that are going to benefit from this trend. We think AI is a long-term mega trend, and the future is really now. And we're hearing it from the companies, and we're seeing investors really gravitating towards learning about these ETFs.
And are we seeing more of a push towards the sort of ETF approach? I mean, when you look at the price of, say, an NVIDIA, is this a better way to get into this space? And as you mentioned, this is a long-term play. We don't even know who the biggest players are going to be, say, 5, 10, 20 years from now.
That's true. We don't know who the clear winners are going to be. And so it helps to spread that risk around, have exposure to companies across the AI universe, technology companies, consumer discretionary companies, communications services companies. Instead of just buying one individual stock, an ETF like Global X's AIQ gives you the benefits of diversification. And that's why we're seeing strong inflows into this ETF. It crossed the $500 million mark. It was very small at the start of the year, and it picked up in July, according to our verified data.
And also making your list, TOTR. Talk about the catalyst there and what the expectations are for that ETF.
We are seeing really strong interest in actively managed fixed income ETFs. And so TOTR is offered by T. Rowe Price. Many viewers are probably quite familiar with T. Rowe Price as an active mutual fund manager. They entered the ETF marketplace a few years ago with both equity products as well as now fixed income products. TOTR is a core bond fund. It's actually outperforming AGG thus far this year. The management team is adding appropriate risks and getting rewarded for that. And so we're seeing investors gaining comfort in active ETFs. They believed in active management for years. They just now have many more choices from T. Rowe Price and other fund families to choose from.
And we know a lot of investors still chasing those yields in this environment. So talk about TLTW and the sort of returns that people are seeing right now. And how do you see that perhaps changing as we sort of see what the Fed does, get the CPI data, and eventually at some point the Fed stops hiking?
Well, you noticed, and viewers probably noticed that we cited ETFs outside of some of the larger fund families initially. TLTW is an iShares ETF. iShares is the largest player within the space, so it's hard to find an under-the-radar ETF from them. But we've really seen interest in this buy-right strategy, which is using options to dampen the risk, dampen the volatility of getting long-term Treasury exposure. And so TLTW has actually outperformed the more traditional long-term Treasury ETF, which goes by the ticker TLT. That's the iShares 20-year Treasury ETF. It's outperformed. It's protecting more of the downside. It's offering income. For investors that are nervous about a potential recession, long-term Treasuries are often a good flight to quality for people to turn to. They now have an additional product from iShares that is now over $700 million in assets under management. We spotted it a couple of months ago when it was under $200 million, and it's continued to snowball the assets.
And on the flip side of that, perhaps any ETFs looking less attractive as we enter this sort of environment?
So we are seeing investors being less concerned about protecting the downside in terms of rising interest rates. I think there's expectations that the Fed is nearing or has ended its rate hiking program. That's why taking a longer term Treasury approach. So we're seeing a rotation away from some of those short-term oriented ETFs. So ETFs like SHY, another iShares ETF, which is very short-term downside protection focused. Investors are willing to take on additional risk in order to get higher rewards. We saw that with that emerging market ETF from JP Morgan, and we're seeing it with TLTW as well.
Well, certainly lots of interesting options for investors to weigh there. Great to have you on. Vertify Head of Research, Todd Rosenbluth. Good to see you.
Thank you.
Oh, you're very welcome. All right, all your markets action is still ahead. Stay tuned. You're watching Yahoo Finance.
August and September don't tend to be good for stocks. What do you think is going to happen this time around?
Yeah, September, October can be real scary times in the stock market, but the top tends to come in the month of August. And so people need to be a little bit careful here, especially with interest rates moving up to where they are, banks being downgraded, and the market being as expensive as it is. Doesn't mean it's the end of the world, but it does seem to me that people need to be a little bit more cautious about chasing the market right now.
Key inflation data out of China showed consumer prices fell 0.3% in July year over year. Now, that's the first time in more than 2 years that China's consumer prices slipped into deflation. Let's bring in Yahoo Finance's Jared Blickery to discuss this more. Hey, Jared.
Well, let's take a look at this graph here. This goes back a few years. Purple line is consumer prices, and you can see they just barely dipped into negative territory. That is a huge problem for the central bank over there. You can agree with it or not, but the biggest fear that central banks have is a deflationary spiral, and this is the first step. Actually, producer prices, I should say, in the cyan line, those dipped into negative territory in the fourth quarter of last year, and those can be seen as a bellwether of what's to come. But the bottom line is China has been trying to goose their reopening, and they have been failures so far. They've tried to stimulate various sectors like the property sector on its own because they don't want a wholesale inflation to eventually come and grip the country. But as you can see, they really don't have to worry about inflation too much right now. But let me show you why that could be important in the future. We need to take a look at the Chinese currency, the US dollar versus the Chinese yuan. This is a year-to-date chart. And the higher the line, the stronger the US dollar is, and the weaker the Chinese currency is. So when it goes up, that means the Chinese currency is weakening. Right now, we just broke out of a consolidation, and this means that the Chinese yuan is weakening higher. And this is important because a key level is just above. We can see we hit this high last year. If we go above that high, who's to say where it would stop? Because let's take a look at a max chart. In fact, we'd have to go all the way back to before the global financial crisis to find any period of time in which we had some price history here. And in fact, there's very little overhead resistance. So the Chinese authorities are trying to stimulate the economy. Their last relief valve is probably a devaluing of the yuan. They did that in 2015. They don't want to do that again. It comes with all kinds of political costs, but their backs are up against a wall here. Let me show you what's been happening with the Nasdaq Golden Dragon Index components today. This is a China-centric market, and you can see kind of a mixed board. Over the last 5 days, we've seen some significant weakening here, but over the last month, and in fact year to date, we've seen largely positive price action here. So stocks being forward-looking, you could say a number of things about them, but the stock market there not under as much pressure, or not showing as much pressure as you might think, with the country outright going into deflation. Going forward, I'm going to be honed in laser-like on the authorities there, the PBOC, whatever measures they come out with. As I said, the final backstop is probably a wholesale devaluing of the currency, which they want to stay away from, but that is a possibility at this point, Rochelle.
Indeed, and clearly consumers not willing to spend. And China, historically a nation of savers, still not motivated to spend at the moment. We'll be keeping an eye on that. Thanks so much, Jared. All right, we're talking Disney, getting ready to report its quarterly results after the bell today, and it's been a tough year for the company. The media giant has seen its parks business slow, coupled with declining subscribers for Disney+, all while handling the looming question of succession. Well, let's bring in Yahoo Finance's Alexandra Canal for more. Hey, Ali, what are you expecting?
Hi, Rochelle. Well, there's going to be a lot to discuss. We just got that announcement that ESPN will be licensing its brand to Penn Entertainment to get into the sports gambling business. That should be interesting considering Bob Iger wants to take ESPN fully over the top as a direct-to-consumer streaming service. I'm sure there's going to be a slew of questions related to ESPN on the earnings call. But in terms of the actual report, it's going to likely be a pretty challenged quarter for Disney. Disney Plus is expected to have lost about 3.6 million subscribers in the quarter, and that comes after they lost 4 million subs in the last quarter. We're also expected to see streaming losses accelerate on a sequential basis. Right now, estimates are calling for streaming losses to mount to 778 million. That's compared to a loss of 1.1 billion in the prior year period. Now, Bob Iger, he has consistently reaffirmed that the company will reach streaming profitability by 2024, but but that's going to be a pretty bumpy road ahead. And speaking of bumpy, you also have that shaky advertising environment with linear network ad revenue that's expected to decline in the high single digits, very similar to what we've seen from other competitors. On the studio side, we're likely to see some softness there, considering we saw disappointments from the live action Little Mermaid and Pixar's Elemental on the theatrical side. And then overall, we have the Hollywood writer's strike. That's a big question mark moving forward. The park side of the business, that should be the bright spot for Disney. It typically is, but even there, we've had Wall Street analysts seem pretty concerned that there is some softening in demand there amid high inflation. So a lot to dig into this report. Bob Iger is certainly going to be faced with a heck of a lot of questions on the earnings call. We'll see what comes out of it later tonight. Those break right after the bell at 4 p.m. Eastern.
And you figure trying to balance everything, the strikes, some of the slowdowns that we're seeing, what are we expecting to hear, if anything, about potential succession plans?
Well, that's a big question mark, right? Bob Iger, he recently accepted that contract extension through the end of 2026. Now, what's interesting is that we did have a report that Kevin Mayer and Tom Staggs are joining Disney as advisors to Iger to help with that ESPN direct-to-consumer transition. They had long been in the running for the CEO position, so you wonder if that's Iger trying to suss them out to see if maybe they could possibly replace him. And it's going to be a question mark whether we see an internal candidate, perhaps an external candidate. We also have Josh D'Amaro, who runs the park division. There's a lot of people internally that I could see potentially step up to that role. And as important that succession is, I think right now Bob Iger is really just trying to set up Disney for its next phase of growth, really reset the strategy. So in a way, it feels like succession is a bit on the back burner, considering how many issues are on the table right now and how much Bob Iger, all the decisions that he has to make at this point. So that's something that we're going to continue to track, and I'm sure Disney top of mind for them as well.
Indeed. I know you'll be following all of that for us, our very own Ali Canal. Thanks so much. All right, stay with us. All your markets action just ahead. Stay tuned. You're watching Yahoo Finance.
I see you're in your office, got a lot of books behind you. You reading anything good right now?
I tend to read biographies, and right now I'm reading one on Mornings on Horseback about Teddy Roosevelt. You know, that came at a very interesting time in our country, and I think we're facing a very interesting time as well. So hope we can get the kind of leadership we've gotten from Teddy Roosevelt in the past as we move forward in the years ahead.
I don't know where that's coming from, but I hope so too, Matt.
Shares of Nvidia under pressure this morning. Yesterday, the chipmaker unveiled an upgraded AI processor that promises to deliver 3 times the capacity of its current H100 superchip as the demand to run larger AI models continues. Nvidia also announced AI Workbench. Now, that's a space allowing anyone to build custom generative AI models. Open to anyone, the workspace is a one-stop shop where developers can easily access existing models and code, customize them to fit their needs, then deploy them across multiple platforms. The goal? To make AI more accessible. But is that a good thing? Well, joining me now is Nina Schick, author, advisor, and speaker specializing in generative AI. Good to see you, Nina. So, talk about this move, this sort of democratizing of some of these large language models, and what this actually does to competition in this space.
Well, I think it's inevitable, really. If you consider the absolute prowess of the AI revolution, I think what's happening is that we're moving from the so-called information revolution, the internet, the smartphone, cloud, into a new era, the so-called intelligence revolution. And I think the democratization of the capabilities of AI is absolutely essential to reach the real kind of opportunity and potential for artificial intelligence. And the way that NVIDIA has positioned itself as a leader in AI has truly been sensational. I would call Jensen Huang the kind of Michael Jordan of tech CEOs just for this.
So then, by making this move, though, and making it much cheaper, how does NVIDIA benefit then?
So the reason why NVIDIA has been doing so sensationally well is because they have a near monopoly on the hardware to actually compute, to run these huge kind of AI models that are now increasingly going to be a part of all human enterprise activity, or indeed any kind of human intelligent creative work. Like Elon Musk famously said, to get access to these chips, the hardware, it's harder to get access to than drugs. So the fact that NVIDIA has a near monopoly, and of course others are trying to enter the space, Microsoft is trying to build its own chip, and now not only do they have their existing hardware, but they're building an even more powerful chip, is, I think, going to be sensational for the company. We've already seen how well the company's been doing. Its stock, I think, is up over the year by, almost 300%. And I think that rise is going to continue because this essential part of the AI tech stack, hardware, infrastructure, which NVIDIA has a monopoly on, is just going to continue to become even more important and in more demand.
So then, does the growth story from here focus more on business to business or business to consumer?
I think it's going to be B2B as well as B2C. And this is why the democratization element is so fundamental, because so far when you think of AI and generative AI, we've almost been in the last few years for kind of incubation phase where these large foundational models, LLMs, and other foundational models have been being innovated within, usually large tech companies. But now in 2023, as I kind of predicted last year, we really come to the era of exponential growth and mass adoption. So it's not only useful for the enterprise, it's also useful for individuals, for consumers. The key then is that everybody, whether you're a company or an individual person, you need to be able to fine-tune these large models. And really that's what NVIDIA is saying they're going to be doing with their partnership with Hugging Face, for instance, allowing access to these capabilities as we go into this phase of from incubation to mass adoption.
And so then, as we look at competition in this space, if NVIDIA's CEO, as you said, would be the Michael Jordan of this space, where would that put Mark Zuckerberg and Meta's role in this?
That's really interesting. Obviously, Jensen Huang, he made comments at SIGGRAPH at LA yesterday, where he said, we kind of bet the house on AI back in 2018, and nobody knew. And that really proved to be fortuitous and innovative. Like I mentioned, the fact that NVIDIA just has this monopoly over kind of the hardware of what's powering this AI revolution. And if you subscribe to the view, as I do, that we're only beginning when it comes to the real impact of the AI revolution, that this isn't just a passing fad, their dominance is going to continue to grow. All the other tech companies, however, some may be later than others to the party, but all of big tech has fundamentally reoriented towards AI, and Meta is one of those. Meta, was performing pretty badly last year, in part, I think, with this almost like forced top-down vision of the metaverse, which was Zuckerberg's big bet. But this year, it's strategically oriented towards AI and generative AI, and it has been making strides. Why? Because it's been developing large language models, and unlike competitors like OpenAI and Google, which have been releasing these closed, Meta has been releasing them open source. So again, if you tap into this idea that we're now coming to the mass adoption phase of generative AI, the fact that Meta's models are performing so well in their open source suggests to me that Zuckerberg has been willing to give up a little bit of control for more influence in the long term. So Meta's been doing well, but you can't compare Meta's performance to NVIDIA's. NVIDIA's is obviously far, far superior.
Indeed, because a lot of people are still looking for some of these use cases in earnings reports. So when we think of where the next iteration is going to be in generative AI, as we continue to see NVIDIA rolling out super chips, democratizing this process, what are some of the next catalysts that you're keeping an eye on in this space?
So again, I think you really have to conceive of this moving beyond the kind of exponential technologies of the past 30 years, the so-called information revolution, which has been about building this digital ecosystem, right? Which has become a fundamental facet of life. It doesn't matter whether you're a nation state, an organization, or an individual. You exist, communicate, and act in this ecosystem. With AI, it's again, this idea of an intelligence revolution. All human creative and intelligent activity can now be augmented with artificial intelligence. This is why large language models in particular have been so powerful, because of the way that we can instruct AI to gather insights, to do summaries, to generate and create content for us. So again, think of it as an augmenter of human intelligence that we haven't seen before. And this is why I always think of AI as being different than the exponential technologies of the past 30 years. I actually think it's far, far more powerful. I actually think it suggests a kind of tipping point in our relationship with machines and indeed in human evolution.
And just quickly then, with that in mind, obviously we don't know where this is going, as we were talking about sort of exponential change here. What does this mean for regulation and concerns there, as regulators clearly far behind of the advancements that we're already seeing in generative AI and the potential use cases?
Yeah, absolutely. I mean, I've worked with policymakers in the past, and I think it's very difficult for regulators or policymakers to conceive, let alone come up with a framework to regulate exponential technologies that are accelerating this quickly. That being said, regulators and policymakers understand that this is not just a fad, that we are entering this new era of AI, and that they will have to regulate. And you've been seeing them playing catch up quickly. The EU's been formulating the EU's AI Act that's been in the works for many years. It's going to come into action in 2026. So I think regulators are going to be busy. They have their work cut out for them, but because of the profound nature of this revolution, regulators aside, what we've also been seeing is a lot of responsible leadership and thinking on how to roll out this revolution safely, coming from leading enterprise companies, including some of the tech giants in the US, because regulators can't handle this by themselves.
Indeed, and of course, some of these same tech giants still pushing ahead while also calling for some regulation, still pushing ahead though with these developments. So an interesting double-edged sword there. Great having you on, Nina Schick, author, advisor, and speaker specializing in generative AI. Great having you on.
Thank you.
Well, Microsoft is keeping the AI momentum going. The tech giant today debuting a software incorporating artificial intelligence designed to streamline processes for frontline workers. Yahoo Finance's Dan Howley joins us now with more on this announcement. So break this down for us, Dan.
Yeah, Rochelle, this is a kind of co-pilot. This is a type of AI capability that companies are rolling out. Microsoft really pushing the name, which basically means a chatbot, ability to search, ability to go through corporate data, things along those lines. Basically, an AI assistant overall. That's what a Copilot is. So this is Copilot for Dynamics 365 field service. Now, this is for frontline workers, managers, folks who are in areas like technicians who do electrical work or are out in the field doing waterworks, things along those lines. It will allow them to more easily schedule, set up appointments, communicate with customers, things along those lines, basically helping to ensure that these workers get things done more smoothly. It's, again, another part of Microsoft's effort to move forward with AI as part of its overall enterprise offerings. Their productivity suites already have AI. Its enterprise capabilities have AI. They have Copilot for Microsoft 365. We saw the pricing for that at $30 per user per month help elevate Microsoft's share prices last month. Since then, in their earnings report, they've fallen off a bit. Pricing for this isn't going to be as wild as that $30. I think it's around $225 a month, but I would have to double check. So it's not going to be massive, but it just shows how much Microsoft is leaning on AI to go across its various product offerings, from Windows 11 all the way to the enterprise and even into the field in this space with 365 Copilot for Dynamics 365 for field workers.
So they're continuing to roll out all these different Copilot actions here for their chatbots. And of course, Dan, before you go, I want to get your take on Meta's Threads. CEO Mark Zuckerberg saying that Threads will roll out new updates this week. So what are some of the updates? And do you think this announcement will attract more users or perhaps get the subscribers to engage more?
Yeah, so we have a post, it wouldn't be a tweet, on Threads, a thread, I guess. Still trying to figure that out. Anyway, basically, Zuckerberg says new updates to Threads this week. Talks about being able directly to share posts from Threads to Instagram DMs, custom alt text for photo and video. Basically, you can put in alt text if you have a video that you want to post so that it'll pop up when people mouse over it. And then a new mention button so that you can, at people or mention them in posts. And, he had mentioned that there's going to be other features coming down the pike. I think really what they need to do, and this is something that I've spoken about before, is add more of a web presence, the ability for social media managers to really lean on Threads as a secondary option to X/Twitter, and provide them with the means to do that easily. That's something that Meta needs to work on if they want this to actually be the platform that overtakes X at this point. Threads came out with a bang. It was, whoa, here's a company that, is really has the ability, scale, and means to overtake X. But since then, I mean, people have kind of cooled off on it. So, it would be interesting to see them roll out even more features that match up with what X has to offer. And then we could really see, blow for blow, which one's going to come out on top. I say blow for blow. Mark Zuckerberg, just want to point this out, on his last thread, he talks about how he doesn't think that he's going to fight Elon Musk. He said he's not holding his breath. So, maybe we'll see this fight still happen, either over the products or them in person.
Yeah, I don't know. Musk's doing a lot of that. Oh, my neck, my back. So I'm like, that. I don't know if that fight's gonna happen. But thank you. I don't know you'll be watching no matter what happens. Our very own Dan Howley. Thanks so much. Well, for the past 20 years, rents have been rising in the United States, so much so that rents have actually outpaced wage growth. Moody's found that the average share of household income spent on rent hit 30% in 2022. Now, that's the highest proportion in around 25 years, and it means that the average American household can now be classed as rent-burdened. That's according to data compiled by Zumper and The Economist. The discrepancy between the affordable studio wage, meaning the wage it would cost for someone to live comfortably in a single studio apartment, well, that's growing much wider than the median salary range. So this particularly prevalent in major US cities. New York tops the list, not too many surprises there, followed subsequently by Jersey City, Boston, and Miami. But this means that a humble studio apartment in a major city is well beyond the means of the average worker. Wages as well as rental costs may vary across the country, but along with the quickly dwindling housing supply and rising mortgage rates, the housing market is certainly looking to be a long-term issue in the United States. All right, well, all your markets action still ahead. Stay tuned. You're watching Yahoo Finance.
What do you think is the biggest single risk for the market right now?
The biggest risk right now is the high level of interest rates because, with the stock market trading at 20 times earnings, that just creates the kind of headwinds that makes it much tougher for the stock market to rally a lot further than it already has. Let's face it, just because people are saying we're not going to have a recession, it doesn't mean that we're going to have a lot of growth. And earnings have actually come down slightly during this earnings season. That's tough for an expensive stock market.
Investors are cashing in on shares of Toast today. That's after the company reported positive free cash flow in the second quarter for the first time since going public about 2 years ago. Toast, which makes software for restaurants, also saw revenue jump nearly 45% year over year, and its gross payment volume climbed 38%. Well, stay tuned for a big interview on tap. Our very own Jennifer Schonberger will be speaking exclusively with San Francisco Fed President Mary Daly tomorrow at 11 a.m. Eastern ahead of the Fed's next meeting in September. You won't want to miss it. That's all for today. I'm Michelle Akufo. I'll see you tomorrow.